through this question, we see what we are told and equally what the examiner was requiring. We see what we are told. So the question reads, Pata Limited, a quoted company which operates in agricultural sector, has investment in a number of companies. The following financial information related to Pata Limited and its investment companies. So we are given the statement of profit or loss and other comprehensive income, basically for three companies, Pata Limited, Soma Limited, and Jana Limited. Then down here, we have the extract of the equity section of the statement of financial position, equally for three companies, Pata, Soma, and Jana. Then we have some additional information, number 1, all the way to note number 7. Now, what are we required to do? Part A, we are required to calculate the value of the goodwill arising on acquisition of Soma Limited and also Jana Limited. And part B, we are required to prepare the consolidated statement of profit or loss and other comprehensive income for the year which ended 30th of June 2024. Now, what I want us to do, we start with the part B, and then we finally compute the goodwill arising on what? On acquisition. And remember what we said is that once you come across this question for group accounts, the first thing you need to do is always to come up with a group structure. And then from there, you come up with a sketch of what you're required to prepare. You go through the additional information as you make the necessary consolidation adjustment. We said you should not start with the workings because those workings will just be consuming a lot of your time. And by the end of the day, we say they are not what? They are not marked. No marks which are allocated to them. So we need to come up with a group structure here. The group structure. So where do we have information about the group structure? Automatically, that one is not within paragraph 1. So that one should be from the additional information. Let's go to the additional information number 1. And we are told on 1st July 2021, Pata Limited acquired 75% of the ordinary shares of Soma Limited for a cash consideration of 4,500 million, when the retained earnings of Soma stood at 2,100 million. At the date of acquisition, okay, so I think we will go through that during the computation of goodwill. But basically, what you're told in the first paragraph of note 1 is that the company called Pata Limited acquired 75% of the ordinary shares of the company, which is called Soma Limited, on 1st July 2021. 1st July 2021. Then we also given that other information in paragraph 1. We will come back there when computing maybe the goodwill and also preparing what is required in part B. Okay, then let's go to note number 2. And you're told on 1st January 2022, Pata Limited entered into a joint arrangement with another entity to establish a joint control over the net assets and the operations of Jana. So remember, a joint arrangement is whereby a company will acquire 50%. Is whereby the parent company will acquire 50% of the share. So we are told this company, that is Pata, entered into a joint arrangement, and that is specifically on 1st of January 2022, to establish a joint control over the operations of Jana Limited. So mean that this company acquired 50% of the shares issued by Jana Limited on which date? On 1st January 2022. 1st January 2022. So we have that information. And then can we first of all go to note number 3? In note number 3, we are told on 1st January 2024, Pata Limited acquired an additional 30% shareholding in Jana for a cash consideration of 500 million. So during the current year, that is on 1st January of 2024, we are told that this company acquired additional 30% of the share in Jana, meaning that this company therefore was able to acquire the control. So the control was basically acquired on that particular date. And therefore, if you can be able to recall what we said, is that in case of a piecemeal acquisition, because this is a piecemeal or stage acquisition, the parent company has acquired the control over Jana through several purchases of shares. We say that we compute the goodwill on the date the parent company acquired the control. So the goodwill in relation to this company will be computed on that date, the date the parent company was able to acquire the control. But basically, before we compute the goodwill as required in Part A and Part B, that is in Part A Roman 1 and also Roman 2, first of all, I want us, we prepare what is required in Part B, and then we go back to Part A. So we said even in an examination set up, no problem with starting with Part B, provided your labeling is clear. The person who is marking your paper can be able to see that you started with Part B, and then you did Part A. You did Part A after Part B. So we start with Part A, that is Part B, whereby we are required to prepare the consolidated statement of a profit or loss, and other comprehensive incomes, which is for the year which ended 30th of June 2024, 30th of June 2024. And I hope you can also be able to see our figures there. They are given in million of shillings. So we just need to have a single column here, a single column, and our figures are in million of what? Of shillings. We said even before we proceed to prepare this, it is important for us to determine whether there was any company which was acquired during the current year. So like the first company here, that is Soma, you can see the date it was acquired. It was acquired back in 2021. So we are required to prepare this one for the year 2024. So automatically what that means is that we, when preparing our consolidated statement of profit or loss, we will take the revenue and expenses for this subsidiary for the whole year. For the whole what? Year. It was acquired back in 2021. The parent company had a control over this subsidiary for the full year, So, but now this one, that is Jana, you can see the parent company acquired the control on which date? This date here. That is 1st January 2024. The year is ending 30th of June 2024. So the year started here on 1st of July 2023. So how many months do we have here? Basically here we have 6 months because we have July, August, September, October, November, and December. And then here we have 6 months. So here we have 6 months. Here we have 6 months. Now, in the first 6 months here, our parent company had a shareholding of what? In Jana. So our parent company, before acquiring this additional 30% of the shares, the parent company had what? 50% what? Shareholding. So if that is the case, then this company for the first 6 months, it was a joint arrangement, or basically it was a joint what? Venture. And then on this date, the parent company acquired an additional 30% shareholding, meaning that in the last 6 months, the parent company had 80% shareholding in what? In Jana, meaning that Jana for the last 6 months here, it was what? It was a subsidiary. It was what? A subsidiary. That information is very important when it comes to the preparation of our consolidated statement of profit or loss. So it basically means that in preparing this, we are going to take the revenue and expenses of the parent, that is Pata and Soma for the whole year, we combine them. And then for Jana, we will only take the revenue and expenses for 6 months because it was only a subsidiary for 6 months. Then for the time it was a joint venture, we will compute something called the parent company share of the joint venture profit after tax. So, yes. So let's do that here. I want us to go back to is 1430. Is 1430. And then we say make sure this figure by the end of the day you get it correct, because we say the only adjustment affecting this is any sales between the parent and the subsidiary. So we will check whether we have that as we go through the additional information. Then from there we have the cost of sales. We do the same. The full amount for the parent, that is Pata, Soma for the whole year, and basically for Jana half. Half, that will be 740. Then from there we will get the gross profit. Now, before we proceed to less the expenses, remember This particular company here, that is Jana, for the first 6 months, it was a joint venture. It was a joint venture. So what do we need to include here? As far as the joint venture is concerned, we need to include something called the group share. We add the group share of joint venture, or basically we can just refer to it as, yes, let's just refer to it as joint venture. Joint venture, profit after tax. So let's go to the income statement of this company here. From the income statement of Jana, how much was its profit for the year? The profit for the year for Jana from the income statement. Profit for the year for Jana, can you see that value? Yes, it is 500. So the first thing we need to do is, because this is the profit for the whole year, we want to compute the profit for the first 6 months, apportion that on time basis, and then get the parent company share of that. The parent company share will be 50%. 50%. So we get half of this, which is 250, and then half of 250 will be 125. Remember, I said these items do not have any adjustment. So having said, we can then proceed and realize the expenses. The first expense we have there is the distribution cost. And I hope you can always remember that this is a free mark in any question for group account. In any question for group account, this one do not have any adjustments. So we have 495 plus that of the subsidiary, that is Homa, which is 290, plus half that of Jana, which is 100. That one, we cross the bracket, and actually we take the figure to the last column here. So I'm told this will give us 885. 885. And take into account is an expense. Remember to record it here as a negative. This one is an income. We record it here as what? As a positive. Are you getting that value? 885. Are you getting 885? Maureen, are you getting 885? Faith, are you getting 885? Are you getting 885? 885, yes. Okay, so below that we have administrative expenses. The administrative expenses, we do the same. We take that of Pata 760, that of Jana 650, and half. Okay, that of Soma 650, and half that of Jana, which will be 200. So mostly we say that this one is adjusted with the amount of impairment loss. And then from there, we will get the profit from operations. And then to this, we less the finance cost. Finance cost, we do the same. We take that of the parent, 90, that is Pata, that of Soma, 80, and half that of Jana, which is basically 30. So then from there, we will get the profit before what? Tax. And then to this, we less the income tax expense. Income tax expense is the other free mark here. So we take that of Pata 340 plus that of Soma plus half that of Jana, which is basically 110. We close the bracket, we get the final value there. We get the final value. We get the final value there, which I'm told is what? Which I'm told is 820. 820. 820. Are you getting 820? 820. So that will be the profit after tax. The profit after tax. The profit after tax. The profit after tax. I need a confirmation whether that figure is correct. Are you getting a figure of 820? Okay, yes. So then below that, we add other comprehensive income, OCI. OCI, we have the gain on property devaluation. We have the gain on property devaluation. So in this case, we should take that of the parent, which is 265. And then for the other company, that is Homa, equally for that, yes. And then for the other company, you can see that is Jana. that company is not having any revaluation reserve. So meaning that equally these one do not have any adjustment. In case you come across this, unless maybe you had a revaluation gain for this, that is the only revaluation gain which requires some working. But I think in our case, these two will not be having any working. So we just get the final figure of 340 what? 45. 345. So you can see basically that question, even without having dealt with the note, you should be able to get some free marks here. You should be able to get some free marks here. Some free marks there. Now, before we compute the goodwill, I want us to go through the additional information, and basically we see which items need to be adjusted here. We will start with note number 1. Let's go back to note number 1, additional information number 1, and specifically in additional information number 1, we go to paragraph 2. Paragraph 2. In paragraph 2, we are told at the date of acquisition, the fair value of the identifiable net asset approximated their carrying values with an exemption of an item of plant whose fair value exceeded the carrying amount by 600 million. So automatically that is a revaluation gain. That is a revaluation gain. That is a revaluation gain by which company? This is a revaluation gain by this company, because whatever you given in note number 1 is about acquisition of Soma here. So Soma Limited, on the date of acquisition, it revalued the assets. There was a revaluation gain of how much? Of 600 million, because we are told the fair value of that asset exceeded the carrying amount. So 600 million is a revaluation what? A gain. So we are told the plant had a remaining useful economic life of how many years? 6 years. So who can tell us what do we need to compute as far as this revaluation gain is concerned? What do we need to compute here? As far as this revaluation gain is concerned, what do we need to compute? What do we need to compute? Specifically, I'm told by this, we need to compute depreciation. The specific name for that, once the subsidiary company revalues the asset on the date of acquisition, what do we compute? We compute something called what? The depreciation other charge. The depreciation what? Other charge. Depreciation other charge. So how do we compute the depreciation other charge? We take the revaluation gain, 600 million. We divide that with the remaining useful life. We are told there are 6 years. And then we multiply that with the proportion of time. Remember, in our case, what we say that when computing the depreciation other charge to be adjusted here, we compute the depreciation other charge for the current year only. So in our case, remember, this company was acquired like how many years back from this date? So, or basically, how many years do we have from the date this subsidiary was acquired to the date of consolidation? So the first year ended 2022, 2023, 2024. So in this case, if, for example, we were preparing the consolidated statement of financial position, you multiply this with 3, such that you get depreciation other charge for 300 million. This one should be deducted from the PPE. But when preparing the consolidated statement of profit or loss, we only consider the depreciation other charge for the current year only. The depreciation other charge for the current year only is how much? Is 100 million. Is 100 what? Million. So what we consider here is depreciation other charge of 100 million. And what are we told here? Are we told how the company accounts for depreciation? No. In this case, we say this, the question is silent. Any depreciation other charge should be added here. Should be added to the group what? Cost of sales. Should be added to the group cost of sales. So we are done with that. So, but also remember, when computing the goodwill on acquisition of this subsidiary, this 600 million is a pre-acquisition revaluation reserve. So we're going to use it in the computation of what? Of the goodwill. When computing the goodwill, that will be one of the pre-acquisition revaluation reserve. Okay, so we have that. So then let's move to point number 2, and we are told on 1st January 2022, Pata Limited entered into a joint arrangement with another entity, to establish a joint control over the net assets and operations of Jana. Pata Limited acquired 50% of the ordinary shares of Jana Limited for a cash of 700 million when the retained earnings of Jana amounted to 1,300 million. Pata Limited, equity accounted for its share of interest in Jana Limited in line with the International Accounting Standard number 28, investment in associate and joint venture. And then in note number 3, so as far as note number 2 is concerned, there is nothing which will be affecting our consolidation or no a consolidation adjustment we need to make here as far as note number 2 is concerned. Sasa, what about note 3? We are told on 1st January 2024, Pata Limited acquired 30%, or that is additional 30% shareholding in Jana for a cash consideration of 500 million. The fair value of the original investment as at 1st January 2024 was 950. All that information we are going to use it in the computation of goodwill arising on acquisition of this. So that information we are going to use it in the computation of goodwill. And then you're told no fair value adjustment was necessary in respect of the identifiable net asset of who? Of Jana. Sasa. So no consolidation adjustment we are going to make to this in relation to note number 3. In note number 4, you're told the group policy is to measure the non-controlling interest in subsidiary at their proportionate share of the net asset. So this is basically to guide us in terms of knowing which method to be used in the computation of goodwill. Automatically, we said, as per that note, we are going to compute the goodwill using the partial goodwill method. Number 5, we are told, during the year which ended 30th of June 2024, Pata Limited, which is our parent, sold some goods to Soma. Sold some goods to Soma Limited at for shilling 340 million fair value. So that is basically amount of intra-group trading. So that one should be deducted here, 340, and also should be deducted here. 340. And then you're told Pata Limited made a loss of 55 million. 55 million. I said that you need to compute something called the unrealized loss, which we say should be half of this. Half of this, and I think that of this. Half of this, and I think that was coming to 27.5. Is that the position? Yes. But basically what you need to know is that if the parent company here sells some goods to the subsidiary, that is Soma, the goods were sold by this company at 340 million. 340 million. So this 340 to this company is basically a selling price. Is a selling price. If I sell some goods to you, maybe at 340 million, to me is a selling price. What about to you? That 340 will be what? 340 will be what? In your books of account. Whenever you're recording that in your books of account, put that 340. Is it still a selling price? Or is cost? The 340 in your books of account, is it a selling price? Is it a cost? I've sold some goods to you, maybe having a value of 340 million. I'm saying in my books of account, that is a selling price. That is a selling what? Price. What about in your books of account? In your books of account is a cost. In your books of account, that is what? That is a cost. That is what? The cost. Now, if you can be able to remember now what you have been doing in all the other questions for group account, usually we come across questions whereby we compute the and is actually what? Overstated. But now, if you come across this particular question, and basically you're told the selling company sold the asset or even some goods at a loss, sold the goods at a loss, the goods at what? The goods at a loss, then in this case, when preparing the group accounts, we always ignore that what? We ignore that loss. We ignore that what? Loss. In that case, we will not compute the and realize what? Loss, like basically what I've explained in our previous class. Because if we do that, we will come and maybe adjust it in the closing inventory. And actually, you can see the closing inventory we have said is valued at cost. Is valued at what? At cost. But basically, let's not go into details about that. What you need to note that if we are told the goods or the selling company sold some goods and made a loss, so in that case, always ignore that particular word, loss. That's that. So you will only make an adjustment whereby the goods were sold at a profit. So if the goods were sold at a profit and some of the goods remain unsold at the end of the year, that is the only time you compute them, and it is what? A profit. And actually, we know that this profit, number one, we add it to the group cost of sales and we less it from the group inventory. But in case the goods were sold at a loss, that is something you need to note, was sold at a loss, basically ignore that loss. And I'll say that this is based on IS2, because if we will account for that particular and there is loss, then the value for the closing inventory will be reduced below the cost, will be reduced below the cost. Remember, according to IS2, we should always value the inventory at the lower of the cost or the net realizable value. Sasa, yes. So that loss, we ignore it. We do what? We ignore that loss. It will not be adjusted to the cost of sales. It will not be adjusted to the group inventory. In case we are to prepare the consolidated statement of financial position, we don't adjust that to the group inventory. Sasa, yes, that note is important. So we are done with that. So and then number 6, we are told impairment review on 30th of June revealed that the goodwill on acquisition had not suffered any impairment. So we said if you come across that information, you need to come back here and you cross that bracket. No adjustment to the administrative expense, because usually we see that this one is adjusted with the impairment loss. So we can get the final values here. The final value will be how much? 7 what? 760 plus 650 plus 600 plus 200 plus 200. That will give us what? That will give us 16 what? 1610. And we said make sure you record that there as a negative. You record it there as what? As a negative, because that one is an expense. So, and then you are told number 7, all other incomes and expenses of the group are deemed to have accrued evenly throughout the year. So the reason why always you're given that information is for you to know that when taking or when computing the revenue and expenses of JANA for the last 6 months, when it was a subsidiary, you are basically going to apportion that on time basis. And that's specifically what you have done here. Is there anything which need to be adjusted here? I think no. So what we can do, let's get the final values and then we go to the statement, or basically we go back to Roman 1 and we compute the goodwill on acquisition. So we start with the revenue. Give me the final value for the revenue. The final value for the revenue here. The final value for the revenue, I'm told by Gilbert, it is 13,100. What about the cost of sales? The cost of sales, 79 what? 30. 79.30, is that what you're getting? 79.30? 79.30, please confirm. $79.30. 79.30, is that what you're getting? Confirm whether you're getting that value here. 79.30. Yes. Then in this case, we said, for example, if you're doing this question in an examination, I'll not even advise you to compute that one. You see that gross profit, we said by the end of the day that is not marked. Any figure which you get after adding or basically after deducting, do not have any mark. No mark for that. No marks for that. No marks for that. For that there. Yes. So then from there, we have the final value for this one, the group share of joint venture profit after tax. We have the distribution. We have this profit of from operation. No need of even computing that. Can we get the finance cost? The finance cost is going to be 170, 200. Remember to record it as a negative. Remember to record it as a negative. To record it as a negative. Yes. So no need of computing this. No need of computing that. No need of computing that. No need of computing that. Now, if you do that question like that, you'll have gotten all the marks. For example, if you take I was trying to check on the solution for this question here. If you check on how it was marked this particular question here, basically the marks are located. I don't know whether you can be able to see that. You can't be able to see that, but basically this is how the question was marked. Any 7 at 2, and you get 14 marks. The marks are located there were 14. You needed to get 7 correct items. You get the 14 what? Marks. That's why we say these particular items you get 3 marks. They are very important because you can see if you get this one correct, and even this one, because that one do not have any adjustment, distribution, and basically the income tax, you can see those are like 4 items. Those are like 4 items. You need to get 3 other items. So, and actually you can see also this one did not have any adjustment. The finance did not have any adjustment, including what? Including the administrative. Including the administrative what? Expense. You can see that is a question here, which was maybe quite simple. Even if, for example, maybe you adjusted this particular and there is loss, maybe you adjusted here. Equally, you can see maybe the only item which was long would have been long is this one. Sasa, yes. So I think having that, I want us we proceed and basically compute the goodwill on acquisition. The goodwill on acquisition. And I want us to start by computing the goodwill on acquisition of this subsidiary here, that is Soma. Goodwill on acquisition of Soma Limited. Soma Limited, the marks allocated there were 2. I think that one was quite simple. And remember, this goodwill will be computed using the partial. We are computing this using the partial goodwill method as per the information which are given in note number. As per the information you're given in note number 4, we are using the partial goodwill method. So how do we compute this? The goodwill using the partial goodwill method. We start with the purchase consideration paid by the parent. Purchase consideration, which was paid by the parent company. This one is in note number 1. Note number 1. Let's go to note number 1. Note number 1. We are told on 1st July 2021, Pata Limited acquired 75% of the ordinary shares of Soma for a cash consideration of 4,500 million. So the cash consideration paid by the parent was 45. So and then now to this we do what? We less the fair value of net assets acquired. Fair value of net assets acquired. Now, how do we compute this one? We say to compute the fair value of the subsidiary company net asset on the date of acquisition, we take the subsidiary company ordinary share capital plus the pre-acquisition reserves. Now, where do we have the ordinary share capital? So below the information below paragraph 1, we have the statement of profit or loss, and then down there we have the extract of the equity section. So what are we interested with here? We're interested with the ordinary share capital of who? Of this subsidiary, that is Soma. So we go to the equity section of Soma Limited, and the first item we consider here is what? Is share capital. Share capital term, which is 500. So then below that we have the revaluation reserve. We have the revaluation reserve. The revaluation reserve. The revaluation reserve. So this revaluation reserve we need to determine, is it pre or is it post? Is it pre or is it post? Based on the information which are given here. So that revaluation reserve by Jana. Not Jana, sorry, by Soma. By Soma. It is also important for you to check the date. The date there. So that equity balances, they are at the end of the current year, on that year of June 2024. Now, what I'm asking, this revaluation reserve, which we are given here of 80, is it pre-acquisition? Is it post-acquisition? Who can tell us? I'm told by this is post-acquisition. Is this post or pre? Is this post or pre? And also take into account, can you go back to the income statement of Soma? In the income statement of Soma down there, we are also given other comprehensive income. We know that Soma during the current year revalued assets, and there was a gain on property revaluation of 80. So automatically that revaluation gain in the income statement of Soma is a revaluation gain which occurred during the current year. Remember when Soma was acquired? Soma was acquired 3 years back. So therefore, that revaluation reserve, is it a pre or post? A pre or post? A pre or post? Automatically, this one is post because it is for the current year. Since it's for the current year, yes, it is for the current year. That amount of 80, and actually it is the one which is in the income statement. It was for the current year. So that is a revaluation gain of Soma after it was acquired. Do we consider that here? No, because what we consider here is the ordinary share capital of this plus the pre-acquisition reserves. So that one will not be considered here. That one is a post. And then down there, we are given the retained profit brought forward and the profit for the year. I think for Soma, what we need to do, if you go back to the information we have in note number 1, we must be given its retained earnings on the date it was acquired. Yes, Abucha, we're going to consider that one in note number 1. I'm still where we have those the equity section. So we will go back to note 1. Sasa? Yes. So because that it has nothing to do with the revaluation gain we have in note number 1. Now I'm saying if you go to note number 1, you'll be able to see the first sentence or the first paragraph. We are given the retained earnings of Soma on the date it was acquired. Can you see the retained earnings of Soma on the date it was acquired? Because that's what we consider here. We consider the retained earnings of the subsidiary on the date it was acquired, on the date of acquisition. Can you see that amount? The amount of 21. Yes, that is basically what we consider here. That is what we consider here. The retained earnings on the date of acquisition. Automatically, the reason why you're given that breakdown, the retained earnings at the start, the retained earnings for the year or the profit for the year is for us to be able to compute the retained earnings of Jana on this date. Sasa? Yes. So, but for Soma, we are given its retained earnings on the date it was acquired. So, do we have anything else to be considered here? Yes. We said always when computing this, we need to check whether the subsidiary company revalued the assets on the date of acquisition. If it revalued assets on the date of acquisition, any revaluation gain is considered here as part of pre-acquisition. And in note number 1, when Soma Limited was acquired, it revalued assets, and there was a revaluation gain in paragraph 2 of note 1 of 600 million. So that revaluation gain of 600 million, this one was not accounted for, and it is a pre-acquisition. It was not accounted for, and it is what? A pre-acquisition. I think that's basically what we have. I don't think we have any other component of our net assets. So what we need to do here is we get the total. So let's get the total here. Give me the total value. 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 What are you getting here as the total? What are you getting as the total here? What are you getting as the total? The total is basically 32. 32. So 32, we are using the partial goodwill method. So under the partial goodwill method, we're interested with the net asset of who? We're interested with the net assets acquired by who? By the parents. 75%. 75 what? Percent. 75%. So what will be 75% of 32? 75% of 32, it will give us what? it will give us 24. So we get the difference here, which now will be the goodwill, which will be the goodwill, and that is 21. Is it 21? Yes, 21. So basically that, what was referred here. And for example here, what is marked? What is marked here? What will be marked is this. By recording that cash consideration, you have a mark there. Recording this is a mark, that and that. That is basically what is marked. Let me see, for example, how many or how the marks were located here. How are the marks are located here? How the marks are located here? Yes, this is how it was marked. Any 2 at 1. If you get, for example, that cash consideration in the share capital, you already have the 2 marks with you. Sasa is not a must. You get the final figure correct there. You get the goodwill as you get this figure to be correct. So you just need to get 2 correct items. 2 correct words item. That and that will give you 2 marks. So let's move and compute the goodwill on acquisition of this other company. But now you need to note that the goodwill on acquisition of Ghana, the computation of this is quite complex because we are computing the goodwill arising from piecemeal acquisition. The goodwill arising from piecemeal what? Acquisition. And actually we say the computation of that is quite different. It's quite different from how we compute the other goodwill. So let's compute the goodwill on acquisition of Ghana. On acquisition of Ghana, I think I can have that working here. The goodwill on acquisition of Ghana. On acquisition of who? Ghana Limited. Remember this one, or basically this, the parent company acquired the control of Ghana through several purchases of shares. So how do we compute the goodwill arising from piecemeal acquisition? We said always we start with the costs of additional investment. The cost of additional investment. Initially, the parent company had acquired 50% shareholding in Ghana, and then later on acquired 30% shareholding. So this 30%, additional 30% which were acquired, we refer to that as what? Additional investment. So how much amount was paid? How much amount was paid? So we have that here. And then to this we add the fair value of the original investment. The original investment is 50% shareholding. So what was its fair value on the date the parent company acquired the control? That is something always will be given. But equally we said, if for example we were using the full goodwill method, we come and we add the NCI at fair value. We add the NCI at fair value in case we are using the full goodwill method. But remember here, we are using the partial goodwill method. So let's first of all record these 2 values. The cost of additional investment. So when the parent company acquired this additional 30% of the shares in Ghana, how much amount was paid? That information we have it in note number 3. That information we have it in note number 3. That information we have it in note number 3. So the cost of additional investment, the cost of additional investment. The 30% shares were the parent company paid how much? Yes, in note number 3, you're told on 1st January 2024, Pata Limited acquired additional 30% shareholding in Ghana for a cash consideration of 500 million. So that is the cost of the additional investment. Then in the same point, we are also given this one. So we are told that we are told the fair value of the original investment in Ghana on 1st January 2024 was 950. So the fair value of the original investment was 950. Was 9 what? Was 950. Was 950. Now, but if you go back to the information, can we go back to the information which you're given in note number 2? In the information you're given in note number 2, you're told on 1st January 2022, Pata Limited entered into a joint arrangement with another entity to establish a joint control over the net asset and operations of Jana, and then you're told Pata Limited acquired 50% of the ordinary shares of Jana for a cash consideration of 700. So you can see this 50% shareholding, which was acquired back in 2022, was acquired at a cost of 700 million. So that is on 1st January 2022. But on this date, that is on 1st January 2024, the fair value of this, or basically this investment, was fair valued at how much? At 950. So it basically means that we have an increase in the fair value of this 50% investment. So how much is the increase here? How much is the increase in that? The increase in the value for that investment is basically 250. Now, how do we account for this? How do we account for that increase in the value of an investment in a company? So how do we account for that? How do we account for this? There is another question which we did similar to this one, and I was able to explain how we account for that. How do we account for this 250, which is the increase in the fair value of 50% shareholding in Jana? How do we account for this? Who can be able to remember? Who can be able to remember? Who can be able to remember? Who can be able to remember how we account for this 250? Who can be able to remember? Who can be able to remember how we account for this? Yes? Who can be able to remember? There is a similar question which we did, and I think I was able to explain how we account for this. Who can be able to remember how we account for this? Yes. So basically, this one we said that it should be recognized actually as part of OCI. As part of what? OCI. So maybe in that consolidated statement of profit or loss which you have prepared here, you basically recognize it as part of what? OCI. As part of what? OCI. So though that will not be affecting now this one. So can we first of all get the total here? This will give us a total of what? 1450, yeah? 1450. After adding those two values, are you getting 1450? 1450? If yes, yes. So and then now to this, what do we less? We less the fair value of our net assets. Fair value of net assets acquired. Fair value of the net asset acquired. It's also important for you to remember we are computing the goodwill on acquisition of this subsidiary on this date. We compute the goodwill on the date the parent company acquired the control. That's why we are taking, for example, the amount which was paid on the parent, or basically the amount which was paid when the parent company was able to acquire the control, how much amount was paid for the additional 30% shares which were paid, and what was the fair value of the original investment on this date. We compute the goodwill on this date, the date the parent company acquired the control. So also it means that we are going to less the net assets which were acquired specifically on this date. So how do we compute the net asset of Jana Limited on this date? So we will take the ordinary share capital of Jana, and then we will add the pre-acquisition reserves, or basically the reserves which Jana Limited was having on that date. On that what? Date. So let's go to where we have the equity section of Jana, and the equity section of Jana is given below the statement of profit or loss. So the ordinary share capital of Jana is 300. 300. So Jana Limited do not have any revaluation reserve. I hope you can see that. So then in this case, we need to compute the retained earnings of Jana specifically on this date. That's why you can see in that case, we are given the retained earnings of Jana at the start of the year, that is brought forward, which is at the start, and also for the year. For you to be able to compute the retained earnings of Jana specifically on this date here. On that what? Date. So how do we compute the retained earnings of Jana on the date the parent company acquired control? So maybe you can have that here. Because you're given the retained earnings brought forward. So the retained earnings brought forward is the retained earnings at the start of the year. At the start of the year. And that is 1450. So remember, you're interested with the retained earnings here. How do we compute the retained earnings here? Remember, you're given the profit for the year. The profit for this year is 500. Is 5 what? 500. So how do we compute the retained earnings of Jana specifically on this date? And that one is quite simple. We will take the retained earnings at the start, this one, 1450, and then to that we take the profit reported by Jana for the whole year. We basically compute how much profit was reported by Jana here before it was acquired. Remember, you have 6 months here, so we apportion that on time basis. We multiply that with 6 all over 12. So that will give us 1450 plus half of this, 250. That will give us what? That will give us 1700. 1700. Are you getting 1700? 1700. 1700. 1700. Are you getting 1700? Yes. So 1700. 1700. And maybe you can also check whether the subsidiary company devalued the asset on the date the parent company acquired the control. I think there is some information which you're given in relation to them. In note number what? In note number 3, the last sentence, we are told no fair value adjustment were necessary in respect of identifiable net asset of Jana. So when the parent company acquired the control, this company did not devalue the asset. That's that? Yes. So there was no revaluation gain. So we need to get the total, and basically this one will give us what? Will give us 2000. Will give us 2000. And because we are using the partial goodwill method, we are interested with the net asset acquired by the parent. The net asset acquired by the parent will be 80%. Will be 80%, this one. 80%. 80% of this will give us what? Will give us 1600. Will give us 1600. Will give us 16 what? 1600. 1600. So what we need to do is we get the difference. So this minus this one, and that will give us what? That will give us negative what? 150. Negative 150. What is the name given to that? What is the name given to that value of 150? That 150. The name given to that 150. Maureen. Faith. What is the name given to this? Mike. Patrice. The name given to this? Diana. Georgina. The name given to this? That negative 150. The name given to that figure here. That 150 is known as what? And I hope you can see the negative. Or we are wrong? No, we said whenever you're computing goodwill, you can get a positive figure, you can get a negative figure. We said if it's a positive figure, it's a goodwill. But if it's a negative figure, what is that? Yes, you can't remember the name? We say that if you get a negative figure here, this one is known as a gain on bargain purchase. A gain on bargain purchase. A gain on bargain purchase. Gain on bargain what? A purchase. And actually, we say that this gain on bargain purchase, we recognize it in the income statement as part of other income. So therefore, what you'll do, from this consolidated statement of profit or loss which you have prepared, below the gross profit, can you include that gain? Can you include that gain on bargain purchase? Gain on bargain purchase. So this one we recognize it as part of the other incomes. An amount of how much? An amount of 150. An amount of what? 150. That's that? Yes. So if you you get a negative figure down there, that one is a gain on bargain purchase. But if you get a positive figure, we say is what? Is a goodwill. Is what? Is a goodwill. So basically that is it, that what was required in that question. So what is marked here? What was marked there in relation to that Roman 2? So the items which were marked were this one, this, and that, and that. Yes. And basically, actually, this one was there are two marks for two ticks for that because of this, because this was marked. There was a mark for that, and this one. So, and any 4 at 1, any 4 at 1. So it basically means that it's not a must you get the final figure correct, provided you can be able to get that, and maybe some few items there. For every correct item which you get there is 1 mark. Is one what? 1 mark. So that is it. That basically what is required as far as that question is concerned. A very good question on a piecemeal acquisition. A very good question on piecemeal what? Acquisition. On a piecemeal acquisition. Okay, so I think we will take a short break. We will take a short break, and then once we come back, we look on something else. We look on something else after the break. After the break. Yes, so as we come back, can you have this question with you? This one, May 2021, which is question number 2. Not question 2, Lala, question 1. Question 1 is still a question on piecemeal, but let's look on that after the short break of just 5 minutes. 5 minutes, we come back. So we are told the following draft statement of financial position relates to P Limited, S Limited, and R Limited, all public companies as at 30th of June 2020. So we have the statement of financial position for P, S, and R. The non-current asset, current asset, equity, non-current liabilities, and current liabilities. We have additional information number 1 all the way to note number 6. So what are we required to do here? We are required to compute the goodwill on acquisition of S and also R. And then we are required to prepare the consolidated statement of financial position, consolidated statement of financial position. So the first thing we need to do here is basically to come up with a group structure. To come up with the group structure. So where do we have that information? The information is given in the additional information. So in note number 1, you're told on 1st July 2018, P Limited acquired ordinary shares of S Limited, or acquired 80% of the ordinary shares of S Limited. So this company, which is called P Limited, we are told acquired 80% of the ordinary shares of the company, which is called S Limited, on which date? On 1st July 2018. So this is the parent, this is a subsidiary. And then we also given other information here about the revaluation of assets. Maybe first of all, you can skip that. We go to note number 2. We are told on 1st July 2017, P Limited had acquired 5% of the ordinary shares of 𝐼𝐍 and treated this as an investment at fair value through profit and loss in the financial statement to that year of June 2019. On 1st January 2020, P Limited acquired a further 55% of the ordinary shares of 𝐼𝐍 and gained a control. So this company initially had acquired 5% shareholding, and this 5% shareholding in 𝐼𝐍 was acquired on which date? Was acquired on 1st July 2017. And then you're told later, that is on which date? On 1st January 2020. 1st January 2020, this company acquired a further 55% shareholding, and therefore it was able to acquire what? A control. Because you can see by the end of the day, P Limited will be having a total shareholding equivalent to 60%. So this is a piecemeal or a stage acquisition. Now, having said, what are we required to do here? Maybe start with part B before we come back to part A to compute the goodwill. In part B, we are required to prepare the consolidated statement of financial position of P Group. Now, we said in preparation of that, in preparation of the consolidated statement of financial position, because this one is prepared as at the end of the year, that is as at that year of June 2020, we basically need to determine the status of S and 𝐼𝐍 at the end of the year. So automatically this one will be a subsidiary at the end of the year, and equally this one will be a subsidiary, because you can see on this date, 1st January 2026 month to the end of the year, the parent company acquired the control. Still at the end of the year, this one will be a subsidiary. So if it is a subsidiary, it basically means that in preparing what is required in part B, we are going to combine similar items of assets and liabilities of all these companies, P, S, and also what? 𝐼𝐍. But it's also important, maybe, for example, if you're doing this question in an examination setup, it is important maybe you go through what you're given in note 2, note 3, and note 4. Although note 4, there was the aspect of impairment. There was the aspect of impairment of assets, but maybe if time allows, we are going to look on that. So let's go straight to that. We go straight to that, what is required in part B. In part B of the question, first of all, we skip part A. So we are required to prepare the consolidated statement of financial position as at that year of June 2020. And basically, I've said we will prepare this one by combining similar items of assets and liabilities for all our companies here. So let's go to the information we have below paragraph 1. And basically, we have the non-current asset. We will start with the PP. So PP, we combine for all the companies, 3920 plus 21 plus 910. We will see whether we have any adjustments. In addition to what you have below that, investment in S, investment in 𝐼𝐍, do we include that here? No. So instead, what we will do, we will compute the goodwill on acquisition of S and also the goodwill on acquisition of what? Of 𝐼𝐍. And basically recognize that here as what? As an asset. Then we have financial asset. Basically what we say is that also if you come across financial asset, in this question for group account, this one does not have any adjustment because financial asset is an investment in shares. So this one mostly will not be having an adjustment, but we will see as we go through the additional information. So we need to add the financial asset for all the companies. Then from there, below the current assets, or we go to the current assets, we have the inventories. Inventories, we have 315 plus 127 plus 218. So then below that, we have the trade receivables. We do the same. 170 plus 69 plus 118. And then we have cash and cash equivalents. So we have 120 plus 49 plus 84 plus 84. So then in that case, we should get the total assets. So then we proceed and record equity. We proceed and record equity. So at the equity, we have the ordinary share capital. And remember, in this case, we only record the ordinary share capital of the parent. And the ordinary share capital of the parent basically we know remain the same unless there was a share exchange consideration. But I think in this particular question, based on what we have in note number, I think note number 1 and also note number 2, I don't think we have any. We don't have any share exchange consideration, but basically we will be able to see as we go through the additional information. So in this case, we are only taking the ordinary share capital of the parent, the ordinary share capital of the parent. The ordinary share capital of the parent here is basically 1,000, is 1,000. So that one will only be adjusted in case we have a share exchange consideration. The same case with the share premium, that of the parent, which is basically 4,000. That is 400. The revaluation surplus, we will be able to see what you are told. We must be given information about the revaluation surplus for the subsidiaries. And then for the retained earnings, remember this is an item we should not compute. We get the total equity. Below the total equity, also there is something which should be computed and included here, known as the non-controlling interest. That is something we need to ignore, including what? The retained earnings. Below that, we have the non-current liabilities. Non-current liabilities, I can see we have 8% loan notes. So we add for the 3 companies, because these are items of liabilities, 17,500. 17,500 plus what? Plus 475. Then below that, I can see we have deferred tax. So remember what we said, that anytime you come across a component of tax, like this one is a free mark. So because it's a component of tax, this one do not have any adjustment. We have 655. We have 200. And then we have what? We have 260. This one we can get the final figure. We take it to the last column. We take it to the last column. I'm told by Gilbert it would be 1175. So then from there we have the current liabilities. Current liabilities, we do the same. We take the trade payables, and those of the parent, 570 plus 135 plus what? 45. We will check whether we have any amount of intercompany debt. Current tax, another free mark here. 575 plus 75 plus what? 25. No adjustment for that. Any component for tax, be it in the income statement, be it in the statement of financial position, no adjustment for this. That will give us what? 675. Yes. So we are done with coming up with a sketch. So what we need to do is we go through the additional information. We see, do we have any adjustment here? So now, let's go to note number 1. In note number 1, we are told that on 1st July 2018, that is in relation to the acquisition of this subsidiary, on 1st July 2018, P Limited acquired 80% of the ordinary shares of S. On this date, the fair value of identifiable net asset of S was shillings 2,100 million. At the acquisition, the retained earnings and the revaluation surplus of S were 560 and 20 million respectively, and then no new shares which were issued. So if you take on what you're given in that point number 1, we are given the net asset. We are given the net asset of the fair value of net asset of S on the date of acquisition, because we are told on the date this company was acquired, the fair value of its net assets, that one was 21. And basically, we know that this comprises of what? This comprises of the share capital plus pre-acquisition reserves. Pre-acquisition what? Reserves. So, and actually, we are told in the same point there, on the date of acquisition, basically, we are saying this one comprises of ordinary share capital plus the pre-acquisition reserves. Pre-acquisition reserves. Maybe first of all, we can take the ordinary share capital of this company. What is the ordinary share capital of S? We get that from the balance sheet of S at the equity. So in the balance sheet of S, its ordinary share capital is how much? Its ordinary share capital is 700. So which reserves was S Limited having on the date it was acquired? We have that in note 1. In note 1, sentence 2. At the acquisition, the retained earnings and the revaluation reserve of S were 560, and 20. So these are the retained earnings on the date of acquisition. This is the revaluation reserve on the date of acquisition. We are told no new shares have been issued. It basically means that the share capital of this company remains the same from the date it was acquired up to the current year. Up to the current what? Year. So why are we given this? If you go back to note number 1, sentence 2, we are told at this date, the fair value of identifiable net asset of S was 21. And I think, okay, note that point. I want us to go to the last sentence of note 1. Last sentence of note 1. We are told the excess of the fair value of the net asset is due to increase in the value of non-depreciable land. This company devalued land, but in that case, we are not given the revaluation gain. Automatically, the revaluation gain will be the difference between this and what we get here. So if you add this, the ordinary share capital of the subsidiary plus these two pre-acquisition reserves, that one will not give us 21. So first of all, after adding these three values, what are we going to get? That will give us 12 what? Will it give us 1280? This one will be, this will be 580. Plus that one will give us 1280. So meaning that there was a revaluation gain on land, which is equal to this one, which is 21 minus 1280. Minus 12 what? 80. And I hope there is nothing which you have omitted here. There is something you have omitted here. Sorry. There is something you have not included here. If you go back to the balance sheet of S, specifically at the equity, I hope you can see we have share capital, and then we have the share premium. In this case, we said if you're given a share premium in the balance sheet of the subsidiary, unless told otherwise, that one is always taken to be pre-acquisition. So therefore, remember these are retained earnings, this is the revaluation reserve. We also need to include the share premium. The share premium is what? Is 100. That one is a pre. That one is a pre-acquisition. So this one should give us 1380. 1380. Sasa is 1380. So what is the difference here? Yes, the difference is 720. So mean that the land was revalued upward with 720. So how do we account for this? This revaluation gain we added to the PP. Number 2 here, it is important for you to note that here we don't compute depreciation other charge, simply because we don't depreciate land. So we only compute depreciation other charge in case the asset which was revalued is a depreciable asset. Sasa? Yes. So the only adjustment which will be made is to add 722 and that value there to the PP. So number 2, we're given some information about the acquisition of R. And I think in sentence 1, we are told on 1st July 2017, P Limited acquired 5% of the ordinary shares in R and treated this as an investment at fair value through profit and loss. And then you're told on that year, on 1st January 2020, P Limited acquired a further 55% of the ordinary shares in R and therefore gained control. And then in the other paragraph there, we are told the consideration for the acquisition of shares in R was as follows. So we are given two dates, 1st July 2017 and 1st January 2017. So we are given the percentage shareholding. So because we know this 5% shareholding was acquired on 1st July, and then 55% was acquired on this date. So we are given the consideration. So the amount which was paid in acquiring 5% shares is 70 million. The amount paid in acquiring this is 560. And actually 560, that is now what we refer to the cost of additional investment. So when computing the goodwill, the cost of additional investment, the cost of this is 560 million. That one would be used in the computation of goodwill. And then you are told down here is at 1st January 2020, the fair value of 5% equity investment in 𝐼𝐍 was 175. That is the fair value of the original investment. So then you're told the fair value of identifiable net asset of 𝐼𝐍 on 1st January 2020, that is on this date, was 910, and the retained earnings stood at 520. The excess of the fair value of the net asset is due to an increase in the value of the plant with a remaining economic useful life of 4 years. So equally in that case, this company revalued assets. Are we given the revaluation gain? No. But basically, we are told the fair value of the net asset on this date was how much? Was basically 910. 910. This automatically comprises of ordinary share capital plus pre-acquisition what? Reserves. Plus pre-acquisition reserves. So what is the ordinary share capital of this company? That is 𝐼𝐍. The ordinary share capital of 𝐼𝐍 from its balance sheet, ordinary share capital of 𝐼𝐍 is 350. 350. That is ordinary share capital of 𝐼𝐍. Is 𝐼𝐍 having any share premium? No. I'm getting that from the balance sheet of 𝐼𝐍. Is 𝐼𝐍 having any revaluation surplus? No. And then are we given the retained earnings of 𝐼𝐍 on the date of acquisition? I think yes. I think yes. In note number, that just before note number 3, we are told the retained earnings of 𝐼𝐍 stood at 520. On this date, the retained earnings of 𝐼𝐍 stood at 520. So the difference between what we get here and this amount here is due to revaluation of plant. Due to revaluation of a plant. So can we add these two values here? They'll give us what? They'll give us 870. 8 what? 70. So what is the difference between 870 and 910? And 910, will that give us 40? And I hope that retained earnings we are given, and the retained earnings stood at 520. 520, the share capital is 300. Yes. So that will give us what? 40, yeah? 40. So basically, that is the revaluation gain. This revaluation gain, we need to add it here. We need to add it here. And because whatever the revalued is plant, we also need to compute depreciation other charge. How do we compute the depreciation other charge for that plant? The depreciation other charge for that plant, we will take 40, we divide that with the remaining useful life. We are told the remaining useful life are 4 years. And then we multiply that with the proportion of time. Remember, you're interested with the depreciation other charge from this date. The asset was revalued on this date, 1st January, to the end of the year. And basically, we have 6 months. From this date, the parent company acquired the control to the date of consolidation. We have 6 months all over 12. So this will give us depreciation other charge of what? Of 5 million. That depreciation other charge of 5 million, we list it here. We list it there. We list it from the group what? PP. And then in note number 3, we are told that it is the group policy to measure and controlling interest at fair value. So we are going to compute the goodwill using the full goodwill method. And then you are told the fair value of the non-controlling interest in S, 525, and the fair value of the non-controlling interest in R, 315. That one will be used in the computation of a goodwill. Now, there is a note we are going to skip there because of time. I'll be able to show you this in our next class. So note 4. Note 4, what was being tested here is the concept of impairment loss. The concept of impairment loss, Because of time, we can't be able to finish on that. I think that's what we will start with in our next class, because this one was on impairment of asset. Let's first of all skip that. And then we go to note 5. In note 5, we are told all goodwill arising on acquisitions have been tested for impairment and no impairment loss. And then you're told number 6, neither S nor R had issued new shares since the date of, or since P Limited acquired its shares in these two companies. So basically, in our case here, should we less 40 or add? That is a revaluation gain, Josina. 40 should be added because it's a revaluation gain. Since the revaluation gain, yes, that one should be added, just like what you have done to this 720, the revaluation gain on land. Yes, Georgina, that is very much correct. We added the revaluation gain with less depreciation at the charge. Is automatically a gain, because you can see this one is giving us 870. So the difference. So remember, this is the carrying amount of the asset. So, and this is the fair value. The fair value is more than this. Is a gain. Is a gain. Is a gain we add. Is a gain we add. So I've said I will be able to show you. We are going to deal with the note 4 in our next class because of time. So it basically means that note number 4, because it's about impairment, automatically that one will affect this. So these other items basically will not have any adjustment. So what I want us to do, can we get the final values for these other items except PPE? So I want us to start with this financial asset. We have 315 plus 315 plus 210 plus 490. That will give us a final value of 1015. So here you can see we don't have any unreleased profit, no adjustment to inventory. 315 plus 127 plus 218. That will give us 660. No adjustment for receivables. We don't have any amount of intercompany debt. We have 170 plus 69 plus 118. 357. No cash in transit, no adjustment for this. We have 120 plus 49 plus 84, which will give us 253. No need of even adding the assets here. And then for the ordinary share capital, I hope you have seen, we don't have any form of share exchange here. There is no way we have a share exchange consideration. In acquisition of S, in acquisition of R, the parent company paid a cash consideration. So if that is the case, these two items, the share capital, the share premium, will not have any adjustment. Yes, I think for this one, equally the revaluation surplus, we can ignore that because it will be having some working. So this one, the 8% debentures on row notes, not debentures, no adjustment. We cross the bracket, 17 plus 500 plus what? 475. We get 2675. So trade payables, no adjustment here. We have 570 plus 1.
VAT, April 2022, VAT April 2022, April 2022. That should be question 2. On the VAT April 2022, on the VAT. So are we there? Are we on it? April 2022? If you're on it, we'll respond with a yes. Perfect, if you're on it. So that is question 2, Roman C. So question 2, Roman C. Question 2C. Can we start on that question? Can we start on that question? Can we start on that question? Thank you, Douglas. So being told we're being told that the following were extracted from the books of Intercity. The following were extracted from the books of Intercity Limited. And it's all for the month of January, 2022. So the company is registered for value-added tax purpose. So number 1 is sales to the local market, 3.4. How did you sell to the local market? How did you sell to the local markets? That is an output VAT. That is an output VAT. What about sales to the foreign market? Sales to the foreign market. Sales to the foreign market. Output but at zero rate. Then finally we have exempt. We have exempt. We don't charge VAT at all. So then we're being told that purchases and expenses incurred during the month were as follows. That purchases and expenses incurred during the month were as follows. Number 1 is what we call cash purchase. Cash purchase. Are we on it? Cash purchase. Cash purchase. How should the cash purchase? That's an input VAT. Then you have the credit purchase, a figure of 2,250,000. How do you treat it? That's also an input VAT. Then we have salaries and wages. Salaries and wages. Do we have VAT on salaries and wages? VAT is exempted. Salaries and wages are exempted from the tax. And we have what we call the legal services. Legal services. Legal services, how do you treat? That's an input VAT. Then we have stationery. 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 How do you treat the stationery? That's an input VAT. So then we have the next, what we call warehouse rent. Warehouse rent. Warehouse rent. That is also an input VAT. Then we have what we call security services. Security services. Security services. That's an input VAT. Then lastly, purchase of computer. Purchase of computer. Purchase of what we call computers. Purchase of computer, that's an input VAT. So then the last additional information, the examiner tells us the above transactions was stated exclusive of VAT at the rate of 16%. That the above transactions were stated exclusive of VAT. Transactions were stated, we're told exclusive. We say of what we call of VAT. So when you say exclusive of VAT, what do we use when you say exclusive of VAT? When you say exclusive of VAT, VAT has not been charged, so we use 16 over 100. 16 over 100. So then we proceed to the required. The examiner tells us determine the deductible input VAT. If examiner tells you determine, what we call determine, we're told to determine what we call the deductible input VAT. So in this case, we basically examiner implies that you cannot. So you cannot, it basically means that you cannot You cannot trace purchases. Purchases, we say that was sold. That was sold, we say as exempt. You cannot basically trace purchases that was sold as exempted. And therefore you are restricting. In this question, we restrict, and therefore we are restricting together. And therefore we are restricting. We respond with a yes. And therefore we are restricting. And therefore we are restricting. And therefore we are restricting. We respond with a yes. So I want us to start with the output VAT, though that is additional information number 2. We can start with the output VAT. So we have the output VAT. So the output VAT, we have the nature of supply. What do you call the nature of supply? We have the VAT amount. We have the VAT rate, and then we have the VAT. So we have the nature of the supply, we have amount, we have the VAT rate, and then we have the VAT. So number 1, we have sales to local market. What is the figure? So what is that VAT? Sales to local market. 3.4 times 16 over 100. Times 16 over 100. What do you have? So that is 544. Sales to foreign market. Sales to the foreign market. So times 0, times 0. Sales to the foreign market times 0. Times 0. So that is the next part. In essence, to foreign market, that should be export. Export. So you have to write 0. Then we have exempt. We don't need even to put it there, but we can just put it for the sake exempt. So exempt in this case exempts the sales. The figure is 2350. We don't charge. So what is the total? Total output VAT. So what is the total output VAT? Is that understood? So the answer is 2 marks. The question is 2 marks. Where are the 2 marks? The 2 marks is this and this. Once you have that, then that's okay. So together, we'll respond with the yes if you're together. Is that understood? So then I want to get the taxable supplies. We normally say that the taxable supplies is equal to the standard rate plus 0 rate. So we can get the taxable supply in this case. That should be 3.4 plus 5 million. So what is the total? What is the taxable supplies? So the taxable supplies of the 2, we get them to be 8.4 together. So taxable supply is 8.4. Is the taxable supply 8.4? Is the taxable supply is 8.4? Perfect. Then we get the total supplies, what we call total supplies. So total supplies, we have total supplies. So that should be the standard rate plus the zero rate, plus the zero rate, plus exempt, plus exempt. So in that case, we are going to have 3.4 plus 5 million plus 2350 plus 2350. So what is the total? What is the total supplies? Give me the total supplies. So the total supplies in this case, that's 10,750. Total supplies should be 10,750. So that is 10,750. That is essentially 10,750. So that should be 10,750. So then we get what we call total input VAT. We get what we call the input VAT. So we have the nature of what we call supply, amount, the VAT rate, and then we have the VAT. Somebody's talking. Kindly. And then we have the VAT together. So the first one we have cash purchase. We call it the cash purchase. Cash purchase. That is 1.3. 16 over 100. 16 over 100. 16 over 100. 16 over 100. So what is that? 16 over 100. So that should be 208. We have it as 208. So the next we have what we call credit purchases. Credit purchases. Credit purchases. So for the credit purchase, we have a figure of 2250. So we have 16 times 16 times 16 over 100. So credit purchases times 16 over 100. So that should be 360. 360. We have the 360. Salaries and wages we know is exempted. So we have the legal services. So for the legal services, we have it as 650 times 16 over 100. So what is 650 times 16 over 100? So we have it as 104. As 104. So then we have what we call stationery. Stationery was 720. 16 over 100. 16 over 100. For the stationery 16, that is 115, 200. 115, 200. So we have what we call warehouse rent. Warehouse rent. So for the warehouse rent, the figure is 400,000 times 16 over 100 times 16 over 100. That is 64. That should be 64. Then we have security services. So for the security services, we have 680. So what do you have? Security services, 15 over 100. What is the figure? Very fast. So somebody tells me 108, 800. Then you have the last one, purchase of computer. Purchase of computer. So what do you have? Purchase of computer. $19,200. So we have what's called the total. Total input VAT. Total input VAT. Total input VAT. Total input VAT. So what is the total input? $979,200. We have $979,200. But you're told that we carry out what's called deductible input VAT, implying that we cannot trace purchases that were sold as exempt. We cannot trace purchases that were basically sold as exempt. So what do? We restrict. So deductible, we say deductible input VAT is equal to the taxable supplies over what you call total supplies over total supplies times what you call the total input VAT times the total input VAT together times the total input VAT together times the total input VAT. We respond with a yes. So number one, team, again, if sales were inclusive, we make the sales exclusive altogether. But for this particular question, the sales are already exclusive altogether. The sales are already exclusive. So we don't need to make the sales exclusive, the standard rate to be exclusive, because the standard rate sales are already exclusive. So we just get the total taxable supplies, which we have as 8.4 over total supplies that we have as 10. We have it 10,750 times what you call times the total input VAT, which is that figure. So we get what we call the deductible. We call it the deductible input VAT. What is the deductible input VAT? What is the deductible input VAT? Taxable supplies, which is 8.4 over total supplies, which is 10,750 times 979,200. So we have it at 765,142. 765,142. This is the deductible input VAT. How do I get the VAT payable or refundable? So we understand the VAT payable, so what we call refundable, is equals to the output VAT minus what we call the deductible input VAT minus the deductible input VAT. So the output VAT is 544. Then we have the deductible to be 765,142. So this is basically a refund. So this is basically a refund, VAT refund. So what is the VAT refund? When you learn that, what is the refund? What is the refund? So the refund is 221,142. 221,142. All of us, are we together? All of us, are we together on that? All of us, are we together? Perfect. I want us to pick the last question, then we go to capital allowance. To do the last, then we get to capital allowances. Capital allowances. Is there anybody with a question? Kuna mtu na swali? No one has a question. So I can wrap it. Let me pick a bit of more of a complex question. Not so direct together. Let's see a question that is complex. November 2019 is a bit complex. November 2019, we'll pick a question on November 2019. That should be November 2019. November, we have it as 2019 on the VAT, the bit technical. Open November 2019. November 2019. If you're on it, we respond to this. November 2019, that is question 2C. November 2019, question 2C. If you're on it, we respond to this. If we are on it, we respond to this. The link is there. It is in the group. The link is there. The link is there. Somebody just to forward the link. The link is there. Once you get it, you tell Mwalimu. Once you have it, everything you need is there. Everything you need is there. So then I can start. Can I start the question? So being told that the following are summaries of details of sales day book and purchase day book, details of what it calls the sales day book and purchase day book, and the cash book for Kamata and the cash book for Kamata Limited for the month of December 2018. So when you talk about sales day book, what is a sales day book? What is the function of a sales day book? the function of a sales daybook. What is the function of a sales daybook? So we say that sales daybook, we basically record what we call the credit sales together. We record what we call the credit sales together. We record what we call the credit sales together. Purchase daybook, we basically use it to record what we call the credit purchases. So we have on December 4th, we have 𝐉𝐻𝐶 Limited. The figure is 650. We have 𝐻𝐿𝐿. The figure is 520. We have 𝐎𝐍, and remember 𝐎𝐍 is export. How would you treat an export? 𝐎𝐍 is export, and the figure is 350. So that is zero rated IVA. Then you're being told that on 20th, we have the 20th. So the figure for the 20th, we have what's called the figure for the 20th, we have Ministry of Sport. The figure is 170. What do you say about ministries? What do we understand with the ministry when you're told ministry? When you're told ministry? Eva, kindly can you help somebody who can just screenshot the paper? Douglas is struggling to, I don't know why he's struggling to get the paper. November 2019, sign kindly, somebody to assist on that. Douglas, do you have the link? The link is just, is pinned in the group. Somebody, let's make sure that we support our brother. Has it been done? Somebody has done the paper. Douglas, is that okay? Somebody has done. Thanks. So I've said that the sales daybook is basically to record credit sales, and purchase daybook is basically to record what you call the credit purchases, is to record what you call the credit purchases. So we have December 4th, that is on the December 4th. We have 𝐉𝐻𝐶, that is a figure of 650. That is an output PT. 𝐻𝐿𝐿, that is an output PT. 𝐎𝐍 Enterprise, that is an output, but remember that is zero rated. We charge VAT at 0%. Then we start with the Ministry of Sport. The figure is 170. What do you know about Ministry of Sports? When we talk about government ministries, those who say are VAT withholding agents. Are we together? Those are VAT withholding agents. We are going to withhold 2%. So then we proceed to what we call the purchase daybook. We proceed to what we call the purchase daybook. So we have 𝐽𝐽 Enterprise, that's an input VAT. We have what we call Sonitech, that's an input. But remember, import is basically charged VAT after charging the import duty. So the figure is 420. We have 𝐿𝐿, that is the figure is 200,000. Then we finally have what we call 𝐵𝐶𝐿𝐿. The figure is 180,000, giving us a total of purchase daybook to be 1,110,000. So we look at this together. We look at the figure. So they told that we have a cash book together. What do we use a cash book for? When you have a cash book, what do we use a cash book for? What is the work of a cash book? What is the work of a cash book? When you say a cash book, essentially, what is the work of a cash book? To record receipts and payments together, cash transactions. So number one, we have the figure for the sales. Look at the figure for the sales. So we have the cash sales, that is cash in bank. What is the total cash sales? We can have the total cash sales. So we can have the total cash sales. What is the total cash sales? We'll have it as 960 plus a figure of 450. So what is the total cash sales? What is the total cash sales? What is the total cash sales? Cash sales. So we have a figure of 1410. We have a figure of 1410. So are we going to charge VAT on that? The question is, are we going to charge VAT on that? Are we going to charge VAT? Yes, we are going to charge VAT on that. Then down there on the debit, we are told receipt from debtors. Receipt from debtors. Are we going to use the figures for the receipt from debtors to charge VAT? Are we going to use those figures for the receipt from debtors to charge VAT? No, we are not going to account for that. Perfect. So then we go to the payment side, that is the right-hand side. Number one, we have salaries and wages through the bank. Do we claim input VAT on salaries and wages? Do we claim input VAT? Do we claim input VAT? So we don't claim on salaries and wages because that is exempted. We have the next what we call catering expenses. Catering expenses. When you talk about the catering expenses, catering expenses, that is non-deductible input VAT. Then you have what we call purchases. We can do the summary. Total purchases, we can get the total purchases. Total cash purchases. So we have 5. The figure is 580. And then we have 640. So what is the total cash purchases? What is the total cash purchases? So the total cash purchases is 1220, 1220, 1220. The total is 1220. So that is, we are going to claim. We are going to claim. So then we have what we call furniture. Furniture. Are we going to claim VAT on that? Are we going to claim VAT on that? Why do you say no? Even we've not read additional information. Why do you say purchase of furniture? We are going to claim VAT unless that person is unregistered. Unless that particular individual is unregistered, then we have electricity. Yes, we are going to claim. Next, we have photocopying. Photocopying, yes. The refund to customers. We have a figure of refund to customers. So for the refund to customers, we can adjust this. We can adjust this to less refund. We can refund customers. We can adjust refund to customers. How much is the refund to customers? How much is the refund to customers? What I've been told is the refund to the customers. The figure is 176. So we have 176. So what is the adjustment on sales? If we less refund to the customer, the adjustment is, what is the adjustment on the sales? So that is 1234. Thank you. So I proceed to the additional information. So being told that 𝐻𝐿𝐒 was declared bankrupt. 𝐻𝐿𝐒 was declared bankrupt on the 18th of December 2018, after having paid 400,000 for the goods purchased on 7th December 2018. When somebody is declared bankrupt, what do we do? So remember that 𝐻𝐿, the total figure was 520. So we claim a bad debt relief on, or is it on the whole 520? No. So we're going to have 520 minus 400. We claim a budget of relief on 120, on the figure of 120. We claim it on the figure of 120 together. We claim a budget relief on the figure of 120 together. So then we've been told that additional information, 10% of purchases from 𝐻𝐿, 10% of purchases from 𝐻𝐿 were returned by the company due to poor quality. 10%. Those are returned. They are returned out. Is it outwards or inwards? Return outwards. Are we together? Is it return outwards? 10% is return outwards. So that reduces the purchase 10% off from 𝐻𝐿. That should be 300,000. So what is the 10%? What is the 10%? That is return outwards. So return outwards. So that should be 30K. We have that as 30K. So then we're being told that a credit note amounting to shillings 280 were issued to customer during the month. Were issued to customer. A credit note amounting to 280,000 were issued to customer. Are those credit notes issued or credit notes received? Are those credit notes issued or credit notes received? And how does it affect the VAT account? Is that a credit note? That is a credit note issued. So does it affect the sales or does it affect the purchases? The credit note issued, does it affect sales? Yes, that affects the sales by reducing the sales. Thank you. So the interest of refund to customers in the cash book relate to excess amount paid on cash sales. We have adjusted. Is that okay? That figure is already adjusted at that point. That figure is already adjusted at that point. So then we are being told that all purchase invoice. So we're being told that a purchase invoice of 220 from Dubai traders was omitted from purchase daybook. From Dubai traders was omitted. If a purchase invoice was omitted, how do you correct that? If a purchase invoice was basically omitted, we add it to the input. We definitely add it to the input. If it was omitted, we add it to the input. Then lastly, the examiner tells us all the transactions above are exclusive of VAT at a standard rate of 16%. At a standard rate of 16%, are exclusive of VAT at a standard rate of 16%. That all the transactions above are essentially exclusive of VAT at a standard rate of 16%. What do we use? At a standard rate of 16%. At a standard rate of 16%, we use 16 over 100. So then we've been told required, prepare a VAT account for the month of December 2018, showing what we call the VAT payable or refundable, if any. Showing VAT payable or refundable, if any. VAT payable or refundable, if any. So we're not going to go for a break, but we'll have to finish this question first. before we get to a break. Is that okay? We are going to finish the question first before we take a break. So, does this question involve restriction? Does this question involve a restriction? No. Does it involve a restriction? No. So we can use the VAT account. So then this business is basically called Kamata. Kamata, I'll call it Kamata. I'll call it Kamata Limited. And I call it VAT account. VAT account. We say for DEC 2020, 2018. So we can make it. So this side is what we call the output, VAT. This will be the input, VAT. So we have the output VAT, and then we have the input VAT. So we start with output. So we have nature of what we call of supply. We can say supply amount. We have the VAT rate, and then we have the VAT. So on this side, we have also the nature of what we call of supply. We have what we call the supply amount. We have the supply amount. We have the VAT rate. Then we have the VAT. So the first one we have what we call output. We have what we call, if we like, we can put the date, but not a mass, We have Mwangaza. So we have Mwangaza. So Mwangaza is a figure of 650. Supply amount is a figure of 650. We have 16 over 100. What is the figure? Mwangaza 650 times 16 over 100. Get that very fast. So 104. We have 104. 104. Then we have 𝐍𝐋𝐈𝐍. So 𝐍𝐋𝐈𝐍 was 520. We'll adjust those times 16 over 100. Times 16 over 100. Get for that. ℎ3200. 83,200. So then we have the next. Azina is export. So then we have Ministry of Sport. So what is that to get from that? Then you can have the VAT withholding. Get from that. Just 27,200. So get from the withholding. The VAT withholding, 2%. That is 34. Because it's a VAT withholding agent, you'll not receive the whole amount together. That will be withheld. So then we can come to the purchases. We move with the purchases. We have Mwangaza. So Mwangaza is a figure of 650. So the VAT rate is 16 over 100. Get for me that Mwangaza. 16 over 100. Give me that Mwangaza. Jawabu, sorry. Thank you so much for that. Thank you so much. So what is the figure for Jawabu? Thank you. What is the VAT on that? What is the VAT? Yes, I have corrected. 48,000. Sonitech. So the assumption is that we've included import duty. We have included import duty on that, times 16 over 100. So give me that for the Sonitech. Sonitech. Sonitech nipatie. The assumption is that import duty 67,200. So then we have the next 𝐿𝐿. So 𝐿𝐿, the figure is 200,000 times 16 over 100. So get for me that 16 over 100 times 16 over 100. So that we have, somebody gets his 32. 32. Then we have B Salama. So B Salama, 180. 16%. What is 16%? 28,800. So we come to this, we have what's called the cash sales. After adjustment, what is the figure when we less the 176? What was the cash sales adjusted? That was 1230. Somebody give me 1230. Then you get 16% of that. What is that? Yes, give me that 16. So 197 for 40. Then you had the purchases. What is the summary for the purchases? Cash purchase. Cash purchase. What is the summary for the cash purchase? Provide me the summary for the cash purchase. Provide me with the summary of the cash purchase. So 12 of 20. %, get me. $195,200. $195,200. We have furnitures. So furniture was a figure of 160. Get me that? 16%, 25,600. electricity, (16% of that), 16%, that is 51. We have the photocopy. What is 16% of that? (16% of 24? 3840. So then we have what's called the budget. Plus, because we don't have restriction, team, because we don't have restriction, you can have the budget on this side. If you have it on the input side, it will be a positive. I'm saying, whenever you're dealing with, you're not dealing with exempt, you can have the budget at this side. If it's on this side, it's a negative. If it's on the other side, it's a positive. Is a positive together. So what is the budget? The budget was 120. 16% for the budget. So that's a minus. (10% will return to Jawab. Return, we call it outwards. Suppose it's on this side, it would be positive. This side, it would be minus. That should be 30. So what is the figure for the return outwards? Get me that. So we have 48. So this figure, I hope you're getting. You can use this figure interchangeably. If you have return outwards here, it will be positive. It will be a positive. Are you getting that? If you have the budget on this side, it will be a positive. It will still give the same value. That is in case we do not have exempt. Is that understood? So finally, if you're together, we give it a yes. If we are together, we respond. Thank you. Then we have a credit note amounting to this was issued. So we have a credit note issued. Credit note issued. So the credit note issued is a figure of 280, 16%. Well, less than. Or you can have this and have it as a positive. What is the credit note issued? $44,800. $44,800. So then we have the next is omitted invoice. Call it omitted. So the omitted invoice is 220. Get from it. Omitted invoice, get for me that. $35,200. Is there an entry that we have not done yet? So which side is bigger than the other? Is it the output or the input side? To get the balancing figure. Which side is greater than the other? Is it the input or the output side? Is it the input or the output side? So what is the figure for the input side? What is that figure? If you add it to give us the Add that so that we can get the figure. Kindly very fast. I want to come and do a question on investment allowance. So make sure that you finish that. Give me this so that we can do a question also on investment allowance. Tafadhali. There's a question that I want to pick. So is it 436,160? 436,160, is that the figure? Input, is it, what is the figure? Somebody to confirm, not only one person. Either say 436. To do work with Ida, Ida's 436,160. Is it correct? 436,160. So we have what called 436,160. So then if that is what, then we are going to have what called a VAT refund. What is the fund? So what is the refund? VAT refund as a balancing figure. Is that 91,720? Is it 97 or 91,720? Which is which? Are we got 91,720? Douglas is getting 97. What is the figure? Awiko says 91. Douglas says 97. $91. So let me work with the two. So we have sorted that question. Is there anything complex in this question? Is there anything complex? Is there anything complex? Have you all understood this question, this VAT question that I've done? Have we all understood? Yes. Can I rub it? Can I rub it? Okay. So we come back and now we start on investment. We do questions on investment allowance. We do a question on what we call on the investment. I want to pick a smaller question that we can finish. There's a smaller question that we can finish. I can give the question so that when we come back, something on December 2023. Somebody to open December 2023. There should be something on investment, a much smaller item on that. Yes, question 4C. Question 4C. December 2024, 2023, deck 2023. We have this question 4C. So as we go for a break, this is a question that we're coming to do on investment allowance. Is that noted? We are coming to do that on investment allowance. As we take a break, is that noted? And we have to finish that. Can we begin that question? Can we begin the question? Can we begin the question? Can we begin that particular question? So perfect, we can see it. We can see with that question. So we are being told, Fountain Limited manufactures soft drinks for sale in the local market. The company started operation on 1st January 2021 and acquired stroke constructed the following assets. Acquired stroke constructed the following assets. So number one is a factory building. The year is 2021. The figure is 40 million. So it qualifies for investment allowance at what rate? That is a factory building. It qualifies for investment allowance at what rate? 50% in the first year and 25% per annum on the straight line. That is from the second year on the remaining balance. What about the factory machine? First year should be 50%. Then the second year is 25% on a straight line on the remaining balance. That is from the second year. Then we have what's called the lorry. Lorry that qualifies for wear and tear, that is at the rate of 5%. We have a go down, a go down, a go down. Go down is 10%. Computer, that should be, computer should be 25%. Then we have computer softwares. Computer softwares should also be 25%. But look up on this saloon car. Which year is that? Saloon car is 2022. What is the rate for the saloon car? The rate for the saloon car is 25%. But remember, we restrict to 3 million if the value is more than 3 million. Then other machineries, where will other machineries go to? When you're told other machineries will go to 10%. 10%. So being told to compute investment allowance for Fountain for the year ended December 2021 and 2022. So Fountain investment we'll call it a Fountain Limited. We have it as investment. Allowances 2021. So 2021. So we call it nature of what I call of the item. Nature of the item. We have the qualifying cost. We have investment. Investment allowance rate. We have what's called the investment allowance rate, the investment allowance rate, the investment allowance rate. Then we have the investment allowance. Then we have the residual. Are we able to see that? Are we seeing that? If we can see that clearly, we also respond to the yes. So we start with the factory building. Qualifying cost, that is 40. The rate is 50% for the first year. That should be 20. Residual is 20. So I have the next factory machine. Factory machine. What is 50%? 50% of 12,500,000. What is 50%? That should be 6,250,000. 6,250,000. 6,250,000. Then you have lorry. So the figure is 10 million. The rate is 25%. That should be 2.5. 2.5, that should be 7.5. That should be 7.5. Then we have a go down. We have a go down. So a go down is 4.1. So that should be 10%. That should be for 10. What is the balance for 10? What is the balance for 10? What is the balance for 10? Provide me that balance for 10. That is 3690. So then we have what's called computers. Computers. Then you have computer software. Computer software. That should be 240. %. 25%, that should be 60. Then that should be 180. Remember, that is for 2021. So 2021 ends there. So what is the investment allowance for 2021? Investment allowance for 2021. So get it for me, the investment allowance for 2021. Get it for me. For 2021, 20 million plus 6,250,000 plus 2.5 plus 410 plus 260. Wonderful people, give me that. So provide me that. So give me the figure, kindly. Give me the figure. $29 for 20,000. 9 million. So that's okay. 2021, is that understood? Is 2021 understood? Is that understood? If that is understood, we respond with yes. So those are 7 entries. So I want to use the same. I just want to wrap and use the same. So on the second year, what do you use for the factory? We use the remaining balance, and now the rate is 25%. So 25% of 20 million, what should you have in 2022? 25%. Now for the second year, 25% on the remaining balance on a straight line. What is it? So that should be 5 million. 5 million. This should be 15. Tuko sawa? Are we together? You give me a yes if we're together. Kama tuko pamoja, you give me a yes. Thank you. So then we proceed on the second year. We use the remaining figure that should be 62.50. We also use 25%. What is 25% of 62.50? 25% is 15,62,500. 15,62,500. So minus this 62.50 minus 15,62,500. What is the balance? What is the residual? What is the residual? What is the residual? 46,87,500. 46,87,500. Then we have the lorry. Because in a straight line, you still use 10%. The figure remains the same because on a straight line, the only thing we'll remember is to remove 2. So the remaining amount is 5 million. Is this understood? We say that for wear and tear, then are on a straight line. So the same, unless there's a disposal, the figure remains 2.5. But remember, we're also losing another 2.5. 2.5. Is that understood? If that is understood, we respond to the yes. Is that understood? Perfect. So again, I move to the go down. The figure remains the same because on a straight line, the figure is, so less for 10 on this. Remove for 10 on that. Remove for 10 on that figure. 3690 minus for 10. 36 minus for 10. Is it 4280? Is it 4280 as the balance? Mwalimu is requesting. What is the balance? 3690. It's 3280, not 3280. Computers again is on a straight line. We use 800,000, but remember we remove for that. This again is same, that is 240. But remember we remove the 60, so this should be 120. So we introduced those items for 2022. The examiner is very clear. We have the saloon car. Remember, this is restricted. So the value should have been 7 million. So we are only going to use 6 million because that's restricted. 3 million, 25%. That should be 1.5. So that should be 4.5. We have that as 4.5. That should be 4.5. Then I have the last one, we call it other machineries. Other machinery, that should be 3. We use 10%. That should be 30. This should be 270. So what is the total investment allowance? Give me that. Investment allowance, give me for that. Add, you simply need to add. I'm waiting for that figure. Alan, why did you provide me that figure? 5 million, 1,562, 11 to 62, 500. Again, 1, 2, 3, 4, 5, 6, 7, 8. So 8 plus the 6, 8 plus the 7, that should be 15. So just need any. The investment allowance in this question was, the figure was 6 marks. So any 12 times a half, then you have, you say, 6. Is that question sorted conclusively? Well, is that question done perfectly well? So on a Monday, we pick it from there. On a Monday, we pick it from there. Unless somebody has a question, but I beg to stop at that point. Unless somebody has a question, I beg to stop at that point. Are we all sorted? Is the questions sorted perfectly well? So I beg to stop at that point. Just a reminder, we said we would meet tomorrow in the morning. We finish tomorrow in the morning, the public finance tomorrow in the morning. So we keep time 5. We keep time, we make it 5. We keep time, we make it 5. So God bless you and God bless our class. Our class is ended. We can stop it at that point. Blessed night, 𝐿𝐿. Good evening, class. Good evening, class. Good evening, class. Thank you. Thank you, thank you, thank you. So we are the guys who have been blessed to be in class today. So we fold our sleeve and we start. So we fold our sleeve and then we start. So where did we stop? Where did we stop? So there was a last statement, made a number of statements, just a recap of those statements. That in case of, for example, I'm just reminding us of what we said. We say that when you look at water pumps, when we look at water pumps and generator, we basically say that under manufacturing, we basically grant them investment allowance at the rate of 50% in the first year, 25% on a straight line per annum. That is from the second year on the remaining balance. From the second year on the remaining balance. And lastly, we were saying that in case of, let's say, for example, in case of hire purchase, let's say you buy an asset, you buy what you call an asset on what you call hire purchase. If you buy an asset on hire purchase, the value that basically qualifies, we say that the value that basically qualifies, the value that qualifies, if you buy an asset on hire purchase, the value that qualifies for investment allowance is what's called the cash price. Cash price is what qualifies. We say qualifies for what we call for investment allowance. Cash price is what qualifies for investment allowance. We say ignore. We say ignore what we call the hire purchase. So what qualifies for investment allowance? It is the cash price. And we do what? We ignore what we call the hire purchase. It is the cash price that qualifies for investment allowance. We ignore what we call the hire purchase. Together, team. What qualifies for investment allowance in case of hire purchase? It is the cash price. So if an examiner brings a question and gives you the hire purchase and the cash price for a fixed asset, the value that definitely qualifies for what we call the investment allowance, we say is the cash price. Cash price is what qualifies for what we call investment allowance. Perfect. So then how do you get investment allowance? We say that investment allowance is equals to investment allowance or wear and tear. In case of wear and tear, we say that wear and tear rate, wear and tear rate, wear and tear rate, wear and tear rate. Then you say times wear and tear rate into brackets, because initial value, we are not using written down value because that is basically on a straight line, initial value. Then you say plus additions minus what you call the dispo, minus the disposals together. This is how we basically calculate what we call the investment allowance for wear and tear. So the wear and tear rate either is 25 or 10% times into bracket. We say the initial value plus what we call additions. These are assets that have been bought during the year. Then you less assets that have been basically disposed during the year together. Then you less the assets that have been disposed during the year. You give me a yes if you're together. You give me a yes if you're together. Perfect. Then you say the following values. You say the following values we say are used we say the following values are basically used as addition, as addition, we say during what we call the year. So the following values, we use them as addition during the year. The following values, we use them as addition during the year. One, we say, if we buy an asset, we say the purchase cost plus cost incurred, we say before the machine is put to use, plus the cost that is basically incurred before the machine is put to use. We say that the costs that are basically incurred before the machine is put to use, we have installation, i.e., we call it installation cost, installation. We have the taxes, what we call the taxes paid. We have the taxes paid, e.g., we have VAT and what we call the custom duties, etc. VAT and the custom duties, etc. We also have the transportation cost and etc. We also have the transportation cost and etc. So if you purchase an asset, that will be during the year, that will be the value of addition plus the costs that are incurred before the machine is put to use. I have talked about installation, taxes paid, like VAT and the custom duty, but you also have the transportation cost together. We also have the transportation cost together. We respond with a yes, if that is at all. We give it a yes, if that is at all. So then we say the second scenario, say in case of a trade-in, what we call a trade-in situation, in case of what we call a trade-in situation, in case of what we call a trade-in situation, in case of a trade-in situation, the value of the new asset, we say that the value of what we call the new asset. So the value of the new asset, we say that the value of the new asset, brought in, we say qualify as addition. So in case of a trade-in, we basically say that the value of the new asset that is brought in qualifies to be what we call addition, qualifies to be addition together. The value of the new asset that is brought in, that is what is going to qualify as an addition. You give me a yes if you're together. Perfect. Then we say in case of hire purchase, in case, we just put in case of what we call hire purchase, in case of what we call the hire purchase, in case of the hire purchase transaction, in case of what we call the hire purchase transaction, in case of the hire purchase transaction, we say cash price, we say is used and we ignore what we call the hire purchase, and we basically ignore what we call the hire purchase. That in case of hire purchase, cash price is used and we ignore the hire purchase. Then we lastly as an NB, that is an addition, we say that for SUV and what we call saloon car, for SUVs and what we call the saloon car, for SUVs and what we call the saloon car, SUV, if the value we say exceeds 3 million, if the value basically exceeds 3 million, we restrict we say to 3 million. So when you buy an asset, and that is the addition, in case of SUV, those are sport utility vehicle, Mercedes-Benz, Land Cruiser, and saloon car. We're basically saying that if the value exceeds 3 million, we restrict to 3 million. We respond with a yes. We restrict to 3 million. Give me a yes if you're together. We basically restrict to 3 million. Perfect. So then the last part is on the disposal part. The last part is for disposal, we say the following qualifies, we say to be what we call the disposal, qualifies to be disposal value. That for disposal, the following qualifies to be disposal value. Number one, that will qualify to be disposal value, we call it sales proceed. We call it sales proceed of an asset. So the value that you get when you sell an asset altogether, the value that you get when you sell an asset, that will qualify as the disposal value. Together, team, that in case of disposal, the sales proceed, the value that the asset has been sold, qualifies to be the disposal value. Together, in case the sales proceed of an item. The number two is for an item stolen, for an item stolen, for an item that is stolen, or we say involved in an accident, for an item that is basically stolen or involved in an accident. We say insurance, we say that insurance compensation, we say qualifies to be what it qualifies to be the disposal value. Make sure those concepts are at the back of your mind. Let's say, for example, you had an asset, and you're saying that, for example, for an asset that is stolen or involved in an accident, the disposal value will be what you call the compensation. The insurance compensation qualifies to be the disposal value. For an asset that is stolen or was involved in an accident, the value that is compensated by the insurance company is what qualifies to be the disposal value. You give me a yes if we are together. That value qualifies to be what we call the disposal value. Perfect. Thank you so much. Then the last item before we get to the question. For saloon cars, then say for saloon cars and what we call the SUVs, for saloon cars and SUV, for saloon cars and SUV, if the value, we say, was restricted, if the value was basically restricted, if the value was restricted, if the value was restricted, when added, let's say, when added, we say disposal value, we say is determined as follows. So if you're disposing an asset that was basically restricted, an asset that was restricted, during addition, are we together? So the disposal value should also be restricted. I am saying that if when you're adding an asset, the asset was restricted. It therefore goes that when you're disposing, the asset should also be restricted. So how do we get the disposal value in that case? So we say that the disposal value, i.e., we say disposal value, the disposal value should be what you call the sales proceed. That is just the SP, sales proceed. The disposal value should be the sales proceed over what you call the initial cost. Then you say times restricted value, which is 3 million. Are we together here, team? I want us to understand this. That if basically, we are saying that if basically you are disposing an asset that was restricted when you are adding it together. Therefore, it goes that when you're disposing also that asset, you need to restrict. How do we restrict? We say the sales proceed over what we call the initial cost, that is the buying price, then you multiply by 3 million. This will not qualify as what? As the disposal value, but you restrict. What you get is what you get as the disposal value. Tubonyeze yes kama tuko sawa. Tubonyeze yes kama tuko sawa. If you're together, we respond with yes. If we are together, we respond with yes. Perfect. Then I only have to make one statement. In case of trade-in, in case of what we call the trade-in, the disposal value, when you're talking about trade-in, in case of trade-in, the value of the old asset is deducted as the disposal value. We're saying that in case of trade-in, we say that in case of trade-in, lastly, say in case of what we call of trade-in, the value of what we call of the old, asset, we say qualifies as what we call as the disposal value. The value of the old asset qualifies as what we call the disposal value. So that is that. I want us now to go to the practical work. Is there any question before I get to the practical work? Kuna mtu ana swali? Is there a question? Kuna mtu ana swali? Can I proceed to the questions? Can I proceed to the questions? Can I proceed to the question? Is there any question regarding, we move on, perfect. So I want the first question. I want us to start on the first question. I want us to pick on December 2024. December 2024. I want us to pick on December 2024. December 2024. That is question 4C. December 2024. We start with the first question, deck 2024. Question 4C. Deck 2024. Question 4C. Are we on it? Let's start with that question. Deck 2024, question 4C. Deck 2024, question 4C. If you're there, you respond with a yes. Deck 2024. So perfect. So I want us to read that question. So we're being told, Adamil Mwema, the examiner tells us that Adamil Mwema, a retired engineer, Adamil Mwema, a retired engineer, sets up a manufacturing factory in industrial area on 1st January 2023 to fabricate mechanical and automotive parts at a cost of 44,900,000. At a cost of 44,900,000. So then the examiner tells us the operation commenced on 1st January, that is 2023, except for commercial building, which was put into use from 1st September, except for the commercial building, which was put into use on 1st September. So then you're given the breakdown for the manufacturing. So the breakdown of 44,900,000. Number one, you're being told that the factory building, that is 18 million. Which investment allowance does it qualify for? Factory building. Factory building, it qualifies at which rate? Which investment allowance and at what rate? Factory building, which investment allowance and at what rate? Which investment allowance and at what rate? Factory building, which investment allowance does it qualify? At 50%, we call it ID, but you say at 50% in the first year, then you say 25% on the straight line, 25% on the straight line. That is from the second year on the remaining balance. Number two, we call it office within factory building. Office within the factory building, how would you treat that? Office within the factory building. Office within the factory building. When you say office within the factory building, office within the factory building, what does it qualify? At what rate? That's a commercial property. So it qualifies for investment allowance at the rate of? At what rate does it qualify for investment allowance? At the rate of, we say at the rate of 10% on a straight line. You mark them. If you have a physical paper, you mark it them. Then the next we have what's called second-hand imported machinery. Second-hand imported machinery. Second-hand imported machinery. Second-hand imported machinery. So what does it qualify for? The second-hand imported machinery. For the second-hand imported machinery, it qualifies for which investment allowance? Second-hand, remember this is manufacturing. The second-hand imported machinery qualifies for IG. We understand at the rate of 50%, that is in the first year, then 25% on a straight line per annum, that is from the second year on the remaining balance. Then you have the next, what we call land. Land, does land qualify for investment, and which investment allowance does the land qualify for? Does land qualify for investment allowance? Does land qualify for investment allowance? Does land qualify for investment? No, land does not qualify for any investment allowance. So that we are not going to use. The next we have what we call engineer fee for machine installation. What we call the engineer's fee for machine installation. Engineer's fee for machine installation. Engineer's fee, that is IG, at the rate of 50% in the first year, 25% per annum on the straight line, that is from the second year on the remaining balance. The next is what we call the parking bay. Parking bay. Parking bay. Parking bay. What does the parking bay basically qualify? Parking bay. That is also investment allowance at the rate of 50% ID, at the rate of 50% in the first year, 25% per annum on the straight line. That is from the second year on the remaining balance. Then the next we have what we call conveyor belt. Conveyor belt, Matsura. Conveyor belt, Matsura. Brand conveyor belt, what does it qualify for? Conveyor belt. Conveyor belt. Conveyor belt. Conveyor belt. Conveyor belt. So which investment allowance? That is at the rate of 50% in the first year, at the rate of 50% in the first year, and 25% per annum on a straight line, that is from second year on the remaining balance. Then lastly, we have commercial building, and the figure is 10 million. Commercial building, what does it qualify for? Commercial buildings, commercial buildings, commercial buildings, commercial buildings, 10%, 10%. Thank you so much. So I proceed to the additional information. Alan, Ida, thank you so much. I proceed to the additional information. On the additional information, we've been told that commercial building, we are given a breakdown. Commercial building include what we call a showroom. So the figure of 10 million, the figure of 10 million, we can put it as probably working commercial building, commercial. We have it as a commercial building. The figure is 10 million. From 10 million, this one includes what we call showroom. So we have the showroom. We have what we call the showroom. And the showroom and retail. Showroom is 2.8. 2.8. Then we have what we call retail shop. What we call the retail shop. So retail shop is a figure of 3.2. So what is the figure for the commercial building? What is the figure for the commercial building? What is the figure for the commercial building? So what is the figure for the commercial building? If you less that, what is the figure for the commercial building? So when you less that, what is the figure for the commercial building? Because this figure is inclusive of a showroom and retail shop. So what is the difference? Is the difference 4 million? Is the difference 4 million? Perfect. Showroom and retail shop, they qualify for investment allowance at what rate? Showroom and the retail shop. They qualify for investment allowance at what rate? Showroom, they qualify at 10%. At 10%. So that is announced. So then you're being told that factory building include a warehouse. So there's a working two. We have the factory building. What is the figure for the factory building? What is the value for the factory building? What is the value for the factory building? What is the value for the factory building? What is the total value for the factory building? So that was a figure of 18. We had it as 18 million. But we've been told that on this building, on this factory building, there's what we call, there's a warehouse. So we need to less that warehouse. We need to less that warehouse. And the figure is 2.2. The figure is basically 2.2. So what is the factory building? The figure for the factory building. What is the figure for the factory building? The figure for the factory building. Give me the figure for the factory building. Provide me the figure for the factory building. Provide me the figure for the factory building. The figure for the factory building. Provide me with the figure. So this is 15,800,000. Aida tuko sawa? Ida, are we together? Perfect. Abia. Edith, I hope we're together. So this warehouse, what will it qualify for? If we list it, warehouse will qualify for? The warehouse will qualify for investment allowance, that is IBD. We understand that 10% at 10%. IBD at the rate of 10%, at the rate of 10%. IBD at the rate of 10%. So we proceed to the next. The examiner tells us that additional information number 3, a building that had been constructed, a building that had been constructed, a building that had been constructed at a cost of 12 million was leased to Juhudi Manufacturers Limited. A building that had been constructed for a figure of 12 million was leased to Juhudi Manufacturers Limited for 5 years. So being told that annual lease rental was agreed at 2.2. Adamil Mwema imported the machinery from China at a cost of 5.2 and installed it in the building and started operation. Do we grant investment allowance for the building that you've leased? Do we grant investment allowance for the building that you basically leased? Do we grant investment allowance for a building that you have leased? Do we grant investment allowance for a building that you basically leased? Either. Do we grant investment allowance for a building that you basically leased? No, we don't grant. That's why if you have options, in order for you to qualify for investment allowance, you buy instead of leasing altogether. If you want to qualify for investment allowance, you buy instead of leasing. Are we together? If you lease, you're only going to be entitled to what you call the lease rental, rentals as allowable expense. But if you have the option to lease or buy in order to qualify for what you call investment allowance, in order to qualify for the investment allowance, in order to qualify for the investment allowance. However, what about the imported machinery of a figure 5.2? Is it going to qualify for investment allowance? The imported machinery for 5.2. Is it going to qualify for the investment allowance? Is it going to qualify for the investment? Yes, that imported machinery is going to qualify for the investment allowance. Yes, that is going to qualify for the investment allowance. So that is sorted. All of us, are we together? All of us, are we together? Perfect. So then I proceed to additional information number 4. So the examiner tells us to improve the performance of the factory. We are being told that to improve the performance of the factory, Adamil Mwema computerized operation at a total cost of 15 million. Adamil Mwema computerized the operation at a cost of 15 million, out of which 30% was software related. So out of which, so we have computers, and then we have the softwares. We have what's called the software. So the figure is 15 million. But the examiner tells us that basically 70% was the computer. So 70% times 75% times a figure of 15 million. So what is 70% times a figure of 15 million? Because that's what 70%, then 30% was in relation to software. 30% was basically in relation to the softwares. 30% was basically in relation to the software. Just a minute. Give me a few minutes. Sorry for the interruption. Sorry for the interruption. So then, 70% is basically in relation to the computers. So what is 70% of 15 million? Give me 70% of 15 million. 70% of what I call 15 million. So that should be 10, 10, 500. What I call the 10, 500. We have it as 10, 500. What about the 30% that is in relation to the software? 30% that is in relation, that should be 45. That should basically be 45. So computer software and computers, they qualify for investment allowance. Number one, computer and computer software, those are wear and tear. At what rate? Those are basically wear and tear at what rate? Wear and tear at what rate? At the rate of 25%. At the rate of 25%. Training at the rate of 25%, not 10%. Training that should be wear and tear at the rate of 25%. So then the examiner tells us on additional information number 5 that the following assets were also purchased. The following assets were also purchased. We say on 1st July 2023. Number 1 is furniture and fitting. Number 1 is furniture and fitting. What does it qualify for? Furniture and fitting. 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 What does furniture and fittings qualify for? Investment allowance at the rate of 10%. Investment allowance at the rate of 10%. At the rate of 10%. What we call investment allowance at the rate of 10%. At the rate of 10%. The next is a second-hand BMW vehicle. Second-hand BMW vehicle. What does it qualify for? The second-hand BMW vehicle. The second-hand BMW vehicle. The second-hand BMW vehicle. 25. But what do we do to the BMW? There's a concept that we have not remembered. What do you do? The BMW Nini, that's an SUV. So what do you do? We restrict to 3 million. The amount that is going to qualify for wear and tear should be, that should be 3 million. We restrict to 3 million. Then the next we're being told that 4-ton lorry, a figure of 1.8. 4-ton lorry, a figure of 1.8. The 4-ton lorry, figure of 1.8. What does it qualify? 4-ton lorry. A 4-ton lorry. Investment allowance at what rate? At the rate of 25%. Thank you, Galva. Then we have the next, that is what we call the backhoe loader. Backhoe loader. What do you call the backhoe loader? So backhoe loader. What do you call the backhoe loader? Backhoe loader. The backhoe loader. At what rate? That's wear and tear. But at what rate? Wear and tear 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 at what rate? Not 10%. Backhoe loader, that should be 25%. Note it as 25%. as 25%. As 25%. Either that should be 25%. Is that okay? Either that should be 25%. Either is that noted? Either that should be 25%. That should be 25% together. That should be 25%. Matsura, that should be 25%. So then we have the next is mobile crane. Mobile crane. Mobile crane. So the mobile cranes. Mobile crane. Mobile cranes. Mobile cranes. Mobile cranes. Mobile cranes. Galma, why did you say that? Mobile cranes. That's not a trailer, the smaller trailer. Mobile crane. Mobile crane. Galma, you are missing it. Mobile crane. Mobile crane should be 25%. Kim, that should be 25%. 25% together. Mobile crane should be 25%. 25% together should be 25%. 25%. Tuko sawa. To give me a yes kindly. Then lastly, we are being told that the factory, the examiner tells us that the factory staff labor quarters were constructed during the year at a cost of 2,250,000 and put to use on 1st October 2023. Factory staff quarters. How do you treat the factory staff quarters? How do we treat the factory's staff quarters? Factory staff quotas. That's IBT at the rate of 10%, 10%. At the rate of 10%. I know you wonder why I chose on this question. I particularly chose on this question because people did not perform well in this particular question. This is one of the questions that was poorly performed. So before I put it down, we're not going to break before we finish. Before we put it down, please, you see there's wear and tear here, number 5 from 1st July. And we have the labor quota that is for the IBD. We are being told that from what? That is from October. We don't apportion. Please don't apportion. Please don't apportion. Is that okay? Do not apportion. Claim the whole amount. Claim the whole amount. Together. Do not apportion. Claim what we call the whole amount. Do not apportion. Claim what we call the whole amount. Do not apportion. Claim what we call the whole amount. So do not apportion. Claim the whole amount. Is that point at the back of our mind? Pardon. Is that point at the back of our mind? Perfect. If that point is basically at the back of our minds. If that point is basically at the back of our mind. So when it comes to investment allowance, I can use 2 methods of doing it. I can separate them, or I can use them as a whole. I've said when it comes to investment allowance, I can basically separate them, or I can do what? I can separate them, or I can carry out investment allowance as a whole, together team. Then I can decide to just accumulate the whole amount and carry out the investment allowance. Or I can decide to do them separately. Or I can decide to basically do them separately. separately. Are we together? So the both methods, I will apply them. But for this first question, I will do it separately. For this first question, I will do it separately. We don't prorate. We don't prorate. Don't prorate them. That's why I'm doing this question, Galma. Yes, because majority of the students failed in this question. And the reason why they failed is because they prorate this. So then we just know that Adamil Mwema, we call it the Adamil Mwema, and we understand that this is investment allowance say for 2023. Adamil Mwema, and we have what's called the investment allowance for 2023. Adamil Mwema, and then we have investment allowance for 2023 together. That is what the examiner compute investment allowance due to Adamil Mwema. So the first method, I am doing it separately. So I start with ID. I call it ID. So investment deduction at 50% in the first year, 25% per annum on the straight line, that is from the second year. So investment, we call it the investment deduction. We call it the investment deduction. We call it the investment deduction. So we separate them. So say nature of the asset, nature of what we call the asset, nature of the asset. We have the qualifying cost. Nature of the asset, we have the qualifying cost. We have what we call the ID rate. We have the ID rate. And then we have what's called the ID amount. And then we have what's called residual. That is the balance, though not necessary because they're not moving to the second year. So we start with the first item. The first item is what's called the factory. We have it as the factory. We have it as the factory building. So what is the value for the factory building? Factory building from our working. What is the figure for the factory building from our working? Nataka watu wakuwe rada. Factory building. Tumepata ngapi? From our working, the figure for the factory building, that is 15,800,000. The ID rate for the first year is 50%. So what is the amount? 50% of that is what figure? 50%. How much is 50%? ID amount, 50%. Watu wangu, 50% of that. Chukua calculator na ufanye. That is 7.9. 7.9. So then the residual is 7.9. So that is the first one. So next is what we call second-hand imported vehicle. What we call second-hand. We call it imported vehicle. So the second-hand imported machinery, sorry, not vehicle, machinery. That out. Machinery. That is 4.4. The figure is 4.4. What is 50% of 4.4? 50% of 4.4. So 50% of 4.4, that should be 2.2. That should basically be 2.2. This is 2.2. That should be 2.2. 2.2. Then we have land does not qualify. We go to engineers fee. We call it engineers. Engineers fee. We call it for installation. So why do we put there? These are the costs that are incurred before the machine is put to you. These are costs that are basically incurred before the machine is put to use. So that is 1.4, 50%, 700. Then we have a figure of 700. Then we have a figure of 700. Then we have what's called the parking bay. Parking bay. We have the next what's called the parking bay. So parking bay is a figure of 900,000. 50%, 950%. We have for 50, and then the balance is for 50. I hope we are moving on well. Then we have conveyor belt. So the conveyor belt is 1.4. 50% of that should be 700. 700. That should be 700. So conveyor belt, we have 1.4, 50% of that should be 700. We respond with a yes. That should be 700. Together 700. That should be 700. Tuko sawa. Kuna mtu ako nyuma. Is there anybody behind? So commercial building, those are not ID. So we turn the pages. So the next ID is what we call imported processing machinery. Imported. We call it imported processing. We call it machinery. So imported processing machinery, the figure is 5.2. Are we in agreement that the figure is 5.2? Are we in agreement that the figure is 5.2? Are we in agreement that the figure is 5.2? Imported machinery. Are we in agreement that the figure is 5.2? 5.2. If we are, then that should be superb. So that is 50%. This should be 2.6. 2.6. The balance is 2.6. Is there any item for ID that we've not added? Is there any item that we've not added? Is there any item that I've skipped? Is there any item that I've skipped? Is there any item that I have skipped? Is there any item that I have skipped? Is there any item that I have skipped? So there's not an item. So we call it, this is summary, we call it the total ID. So what is the total summation for the ID amount? Total ID, summation for the ID amount. Total summation for the ID amount. Tafadhali. Total summation for the ID amount. Total summation for the ID amount. So somebody gets it 14,550. So that is the total for ID amount. What are the entries? Is in your answers 1, 2, 3, 4, 5, 6. Those are the entries together. So then I proceed to the next. I proceed to the next. I proceed to the next. So the next is we can go to the IBD. Those are industrial building deduction. IBD we know at the rate of 10%. At the rate of 10%, we have what we call the nature of what we call asset. So nature of the asset. We have qualifying cost. We have the IBD rate. We have the IBD rate. We have the IBD amount. And then we have what we call the residual. And then we have the residual. So on this, we have office within the building. So we have office. So the qualifying cost for office, that should be 800,000. The rate is 10%. What is that? The rate is 10%. What is 10% of that? What is 10%? Give me that. What is the rate? So that should be 720. That should be 720 as a balance. The next we have commercial. We have the commercial building. So commercial, throughout our working, we divided that as 4 million. So 10%, don't apportion. You don't apportion 10%. So that is 400. Together. Tuko sawa. And today you're not responding. Are we together? Training. Tuko sawa. Training tuko sawa. Matsura tuko sawa. Brian, are we together? Kindly, when you don't respond, we are losing it on learning. So then the other breakdown, we had what we call, we had the showroom, 10%. So what is the difference as residual? 2.8 minus 2.8. Give me the difference. Then we have what we call retail shop. %, that should be 320. So give me the balances. Munipatie hizo balances. $2 million. What about this? Is it this? Is that the figure? 2,880,000. Is that the figure? 2,880,000. Nimeshukuru, asante. So then we have what we call the warehouse. Warehouse. We had the warehouse. So what is the residual? What is the residual? What is the residual? Residual ni ngapi? watu wengi wamekataa. Is it 1980? My people have rejected me. Are we having that? Then you had the staff quarter, labor quarters. Labor quarters, 2,250,000, 10%. That should be 225. So 225, what do you have? $25. So get for me the summary. Total, give me the total IPT amount. Nipatie hiyo figure. Alphabet is 80, 400, 280, 320, 220, 225. That is a figure of 1,525,000. So these are the entries. That should be okay. Those are the entries. Tuko sawa. Munipatie, yes. Galma, kindly don't prorate. I've said kindly don't prorate. Prorate. What have I said? Kindly don't prorate. I have insisted, Galma, kindly don't prorate. Particularly for this question, the reason why students that in this particular year failed this question, because most of these questions, particularly this was the prorated, which get a Galma. Because of apportionment or proration, that's why majority of the students fail in this particular question. Yes, that's why majority, I will always tell you, because lazima tujenge wanafunzi wetu. Is that true, Galma? We must assist our students and make sure that they perform together. So don't prorate. Why did they fail in this? Because of that. That's why I insist, if you're looking at this, what people are doing in the internet, follow what I say. Are we together? You can check other things, but this one, just follow what I tell you. Yes, just follow what I tell you. Can I have this? Can I run? So that we do the last part of it. Can I run? So, Ida, in my class, that's what I told you, particularly for this, Ida, you don't prorate. With the changes that was expected, you don't prorate. Ida, don't prorate kindly. Sawa, Ida. Yes. Mwalimu atakutetea. No, I'm joking. Yes, don't follow what I say. Just follow what I say. I cannot lead you to a wrong direction. Mwalimu will always lead you to the right direction. I know that's a concept that majority, you pick a paper, especially a paper like this, and then you realize it because they prorate and then they miss marks on that. So then we go to wear and tear. I say these things can be done in one, can basically be done in a single. Are we together? We can do this, Galma. We can even do this as a whole. We don't need to separate, but I said we separate. Then the next question we'll do as combined together. We do as combined. So we have the last one that is wear and tear. The last one is wear and tear. The last one is wear and tear. The last one is basically wear and tear. So the last one is basically wear and for the last one is wear and tear. So we have what we call wear and tear, wear WTA. So that is wear and tear. WTA, that is wear and tear. So we have what we call nature of what we call asset, what we call the nature of asset. We have the nature of asset. We have qualifying cost, qualifying cost. We have what we call wear and tear at 25%. We have wear and tear at 10%. Then we have ARC, residual. Then we have the residual. Hapo tuko sawa. Hapo tuko sawa. If you're there, we pick the first one. So we have the furniture and fittings, furniture and what we call the fittings, what we call the furniture and fittings. So the qualifying amount is 620. So the qualifying amount is 620. That is wear and tear at 10%. So what is 10% of 620? We understand not here. 10% of 620. 10% of 620. That should be 62. So 620 minus 62, what is the residual? 620 minus 62. 620 minus 62. 620 minus 62. Don't know the math because even if you put it residual, but we put it, that's not where the max is. So that should be 588. So then we move to the next. We have second hand and BMW. So we say restricted. So the figure is restricted. So we restrict it to 3 million. We restrict it to 3 million. That should be wear and tear at 25%. So this is a dash. So this should be 750. So 750 minus 3 million. And 5% is 750. What is the difference? We restrict because that's an SUV. SUV. So you restrict. SUV, restrict, restrict, restrict. So this is 2 million. Should be 2,250,000. So then we go to 4-ton lorry. 4-ton lorry. What do you call the 4-ton lorry? So the 4-ton lorry was 1.8. So what is 25% of 1.8? 25% of 1.8. 25% of 1.8. What is 25% of 1.8? 25% of 1.8. 25% of 1.8. Now, about this idea na your figure. So then that should be 450. So what is the residual? That should be 13. We have it as 1350. We have it as 1350. Then the next we have what we call backhoe loader. Backhoe loader. Backhoe loader. So we're having a figure of 680. So what is 25, 20? Oh, 558. Thank you. 558. So what is 25% of 3680? 5% of 3680. So that is 920. So what is the residual? Residual negative if you less that. Residual negative. That's okay. Then we have the next, we have the mobile trade. So the mobile trade is 1 point. What is 25% of 25% of that? In 5% of that. So 475. So what is the balance? What is the residual? Perfect. So then we have computers and computer. That is 10. Then you have the computer software. But some people are doing it them as a whole. Some people are basically doing it as a whole. Some people are separate. So what is 25% of 10? 10% of 10, 500. What is 10% of 10, 500? So that's 1425, say 1425. Balance, what is the balance? So what is the 25% of that? Of 4.5. 25% of 4.5. 25% of 4.5. %. Computer is 25%. Computer is 25%. Galma, computer is 25%. So this should be. So what is the residual and residual debt? Somebody lied to me. Somebody has already lied to me there. Huh? So what is the balance? So get our summary. Summary for this, then we do the summary for the whole thing. 𝐎𝐍𝐿. So you're saying the figure is 3375. 33. Is it 3375? Hey guys, I'm saying this addition. I don't think so. So that's 6345. So Galma, are you able to see this, particularly Galma and IDA? The students who basically prorated, that is IBG and wear and tear, they got 0 in all this thing. Are we together? IDA and Galma. For those students who basically prorated or apportioned, this particular question they got is 0. Are we together? Because this was now, because it was from 1st July, this got 375, this was 225, this was 460, this was 237, this was also this one was for the whole year. So maybe this was the only thing that the student got. What are the entries? 1, 7, 8. Then you do the summary. We can now have the summary. So what ID? ID was how much? IBG, then wear and tear, 5. Then we have what's called wear and tear 10%. So what was the figure for the ID? So that we have our summary. Figure for the ID. ID ilikuwa ni ngapi? ID ilikuwa ni ngapi? ID ilikuwa ni ngapi? So that's 14 by 15. IBG was how much? IBG was how much? IBG was how much? IBG was how much? That's 1525. Then this is 6345. So get for me that summary. Get for me the summary. Do for me that summary. Summary, get for me the summary. So it's 22,482,000. So look up, hapa tuko na inchi ngapi? 2, 3, 4, 5, 6, 7. So 7, we add 7 plus 7 under, then plus around maybe 3. So any 1 times, the question was 12, 1 times any 12? 12. 1 times any 12. Is that understood? Has it been understood? Is the question understood? That is how we have it. But I was particularly saying that this information, I can be able to combine all these things. Are we taking and do it as one? Are we taking them? I don't have to separate them. I can as well decide to combine that information and carry out what we call the investment allowance. I can as well carry out, combine the whole thing and carry out the investment allowance. So we can have our break now. We can have our break, then we come back. Is there any person who has a burning question? So God bless you once again. Keep safe and have a great evening. And for my audit students, I was requesting that we meet in the evening at 8. Jaffa, I don't know whether Jaffa has indicated, but I was requesting that instead of early morning, we meet at 8 to around 9:30, 10. That is for the audit students. As Jaffa deliberates with you people, note that Malimu is requesting that tomorrow, instead of meeting very early in the morning, we meet at around 8. So you can go, you can do your personal studies very early in the morning, then we meet at 8 in the evening. Jaffa, he was supposed to communicate that. So we close it there. We close it there. We close it there. Thank you.
In this case, maybe the first thing we need to ask ourselves is what is a manufacturing account? So basically, a manufacturing account, this is an account which is prepared by the manufacturing entity in order to determine the production cost, or basically the manufacturing cost which was incurred by such a company in a certain financial year. So what is a manufacturing company? A manufacturing company basically is a company which buy some raw materials and basically convert that into finished products or into finished goods, which are then sold to wholesalers, which are sold to the final consumer. So that is the first thing you need to understand, that this particular account here is basically prepared by the manufacturing entities. And actually, we are saying manufacturing entities. These are those entities or basically companies which buy some raw materials, and basically convert them into finished goods, or basically into finished products. So mean that these particular companies here, the manufacturing companies, whatever they sell is basically what they have been able to manufacture internally. So they will buy some raw materials, they convert those particular raw materials into finished product, and basically this is now what they sell. Now, what we are saying is that at the end of the year, this particular company must prepare something called a manufacturing account. And the main objective of preparing this account is basically to determine what the production cost, or basically the manufacturing cost. So how much cost was incurred by this company in converting these particular raw materials into what? Into finished goods, or into finished what? Products. So that cost, we are referring to it as the production cost. The production cost, it can also be known as the manufacturing cost. It can also be known as the manufacturing what? Cost. And actually, in this case, we are saying for a manufacturing entity to be able to determine the production cost which was incurred in a certain financial year, so account which is called manufacturing account has to be prepared. So therefore, a manufacturing account, this one is prepared, is basically prepared to do what? To determine the production cost. The production cost, or basically the manufacturing cost, which was incurred in a certain financial year, or basically which was incurred in a certain what? In a certain period. So therefore, the main objective of this particular topic here is basically to know how the manufacturing account is prepared. But it's also important for you to note that other than manufacturing entities preparing this manufacturing account, the manufacturing entities also prepare the other financial statement, the normal financial statement, which include the statement of profit or loss, and also the statement of financial position. But even before these financial statements are prepared, first of all, a manufacturing entity will have to prepare what is known as the manufacturing account. So once the manufacturing account has been prepared, then that is the only time a manufacturing entity can be able to proceed and prepare the statement of profit or loss, and also the statement of financial position. So is there any difference in terms of how we prepare the statement of profit or loss, the statement of financial position of a manufacturing entity? No much difference. There is only a slight difference when it comes to the preparation of the statement of profit or loss, specifically when computing the cost of sales. Even before you look on how we prepare the manufacturing account, when computing the cost of sales, the cost of sales of a manufacturing entity, remember generally when computing this, we take the opening stock. The opening what? Stock. In other terms, we take the opening inventory. So, but now for these manufacturing entities, usually they have 3 types of inventory. They have 3 types of inventory. We have the inventory of raw materials. We have the inventory of the finished product or the finished goods. And also we have inventory of something called the work in progress. Maybe you're going to look on what is work in progress even before you look on how the manufacturing account is prepared. So here, when computing the cost of sales, we take the opening inventory of the finished goods. And then in this case, generally, we should add the purchases. But in this case, we are saying what the manufacturing entity sell is what they manufacture internally. So what we add here is not purchases, because manufacturing entity do not buy to sell, they produce to sell. So what we add here is the cost of the goods which were produced. the cost of the goods which were produced. And actually, we can only be able to determine this cost of the goods which were produced by first of all preparing the manufacturing account. So I want us to look on how we prepare this account. But even before you do that, maybe there are some few terms we need to define here. One is there's something called the prime cost. The prime cost. What is prime cost? Basically, prime cost. This is the total direct costs which are incurred, because it is important for you to note that this particular production cost, which are incurred by a manufacturing entity, this production cost can be generally classified into two. So we have the direct cost, and number two, we have the indirect cost. The indirect costs are also known as the factory overheads. They're also known as the factory overhead. So when we talk about the direct cost, these are those particular costs which basically varies with the level, or basically which changes with the change in the level of production. Anytime the level of production changes, this particular cost will change. A good example is the cost of raw materials. So if the company is not producing any units, the company does not need to buy raw materials. If the company is producing 10,000 units, my raw materials must be bought. If the company increases the number of units to be produced to 20,000, automatically the raw materials to be used will also do what? Increase. So the cost of raw materials is a direct cost. It always change with the change in the level of production. We also have other costs known as the direct labor cost, like the wages which are paid based on the time an employee has worked, not the salary, because salary we know they are fixed. Salaries do not change. So, but wages which are paid on the time worked, or maybe the number of units produced. So therefore, the production cost we are saying is generally classified into two: the direct cost, which are the costs which varies proportionately with the level of production, and then we have the indirect cost or the factory overhead. These are basically those particular costs which are fixed. They do not change. Even if the level of production changes, these costs do not change. A good example is something like rent. If a company is paying a rent of 2 million every month or every year, so whether the company produces or not, that rent has to be paid. So it's a fixed cost. It's an indirect cost. It is a factory overhead. So therefore, the production costs, the costs which are incurred in a production process, they are classified into two. Now, coming back to this, when talk about the prime cost basically is the total. This is the total of the direct costs. The total of the direct cost. So if you take the direct material cost, the direct labor expenses, plus any other direct expense, you get the prime cost. Then from there, we have something known as the work in progress. The work in progress. So basically, work in progress, abbreviated as WIP. This refers to those particular units which are, or maybe to those finished goods which are partially complete at the end of the year. Like, let's take a good example of a company which manufactures something like motor vehicles, or maybe a company which manufactures things like what? Motorbikes. Maybe there are those motor vehicles, there are those motorbikes which are partially complete when the year is coming to an end. Partially complete means that something needs to be done to them before they can be taken to the market. They are not partially complete. They cannot be taken to the market. So we refer to those units as work in progress. As work in what? As work in progress. Then from there we have maybe another term, and basically that is something called the unrealized profit. Unrealized profit. So when talk about the unrealized profit, generally most of the manufacturing companies may be having a policy of transferring the finished goods to the warehouse at a cost plus a certain profit. What does that mean? Generally, what we know is that if we have a manufacturing company or a manufacturing entity, this entity, once it has converted the raw materials into finished goods. So remember, this now take place in the factory. So this conversion of raw materials into finished goods take place in the factory. But these finished goods, are they kept in the warehouse? Are they kept in the factory? No. So usually they are transferred to a warehouse, and basically this whereby now they can be sold. This whereby the company can be able to do what? To go ahead and sell them. So most of the companies may be having a policy that whenever the goods are being transferred from the factory to the warehouse, they will be transferred at a cost plus a profit. At a cost plus what? A profit. For example, maybe you can be told the company transfer the goods at a cost plus 10% what? A profit. So it basically means that this particular profit here, this one is always recognized as an income, is always recognized as an income in the income statement, or basically in the statement of profit or loss. But you can see this particular profit here was based on the goods which were manufactured and transferred to the factory. So, and therefore this particular profit can only be realized if all the goods now which will be transferred to the factory will have been sold, sold, because once a company transfers the goods now from the factory to the warehouse, and there is a profit which is computed on those goods, that profit can only be realized if all the goods will have been sold to its customers. But if some of the goods are not yet sold, then we have the aspect of what? Of the unrealized what? A profit. Now, having known those particular terms, I want us to move and basically we look on how do we prepare now a manufacturing account, which you have said is basically prepared to determine the production cost or the manufacturing cost. The manufacturing account, Now, when preparing this account, the first thing we do is basically to determine the prime cost. Because remember, I've said that this production cost, or this cost which was incurred in terms of producing some units, we classify that cost into two, direct and indirect. First of all, we compute the total direct cost. So we start by computing the cost of raw materials which were consumed. So here we start with the opening inventory, of raw materials. To this we add the purchases of raw materials, the raw materials which were purchased. To this we add carriage inwards of raw materials. I hope you can be able to remember what is carriage inwards. This is basically any transport cost. Maybe a manufacturing company has bought some raw materials, there is some transport cost incurred. So that is carriage inwards. So, and then to this we less purchases return. These are raw materials which had been bought, but they were returned back to the suppliers due to a number of reasons. And then in this case, we get the raw materials available for use. Raw materials available for what? For use. Raw materials available for use. And then now to this, we less the crossing inventory of raw materials. So once you have deducted the crossing inventory of raw materials, we get something called the cost of the raw materials which were used, or the cost of raw materials which were consumed. So these are the raw materials which were consumed, or basically which were used during that year. So after getting that cost of raw materials, the cost of direct raw materials, to this we proceed and we add other direct expenses like the direct wages, or maybe the direct labor cost. The direct labor cost. And maybe we also add any other direct expense. A good example of the direct expense which will be given in this particular question for manufacturing companies is something called royalty. Royalty basically is a cost which is incurred by the company, or basically an amount which is paid by the company if the company, for example, is extracting some raw materials, maybe from a land owned by another person. Like maybe the raw materials used by the company, maybe something like sand. So the company, or maybe that sand is harvested from maybe the land belonging to another person. So the company agree with the owner of that land that maybe for each ton of the sand which is harvested in that land, the company will be paying a certain amount of money. You can see that sand is a raw material, but now the amount which is paid by the company depends with the number of tons which are harvested. Is a direct cost. is a direct cost. So if you're given a royalty in this particular question for manufacturing, is a direct expense. So you add all this, and basically what we get here is now what we refer as the prime cost. The prime what cost? Remember, we have said that the prime cost is the total of the direct cost. So after getting the prime cost, we proceed and now we add the factory overheads. The factory overheads. Remember, I've said factory overheads in other terms. These are the indirect production cost. Indirect production cost, basically, I've said that these are the production costs which are incurred by a manufacturing entity. Basically, they do not depend with the level of production. These costs are constant. Whether the level of production changes or not, they remain the same. They remain the same. I'll just give good examples of this, like maybe the rent of the factory building, rent of factory building. We also have maybe the depreciation of a factory building, building. So we also have maybe depreciation of machinery, etc. So those are basically good examples of indirect costs which are incurred in what? In the factory. So, and then once you have gotten the total here, we proceed and we add something called the opening work in progress. The opening work in progress. And basically to this, we less the closing work in what? In progress. The closing work in progress. So what do we get after doing that? So we get now something called the cost of the goods which were produced. So we get something called the cost of the goods produced. The cost of the goods produced. The cost of goods which were produced. So in other terms, whatever we are getting here, this is basically now the cost of the goods now which were produced by the company during that during that year. Is the cost of the goods which were produced by the company during that year. But remember, I say that most of the manufacturing companies may be having a policy that whenever the goods are transferred from the factory after they have been manufactured to the warehouse, they will be transferred as a profit element. So if a company has that policy, you'll always be given that information. And therefore, what you do, you compute something called the manufacturing profit. The profit which is to be recognized by the factory, we refer to that as what? The manufacturing profit. So in this case, mostly will be given this as a percentage. It should be a percentage of that. So, and then whatever you get here, we refer to this as the transfer price. The transfer price. So why are we referring to this as a transfer price? Is because this is the price at which now the goods will be transferred from the factory to where? To the warehouse. I've said this is basically what happened in a manufacturing company. Once the goods have been manufactured in the factory, they are not kept there because automatically they cannot be sold from the factory. The work of the factory is basically to manufacture, to convert raw materials into finished goods. Once they are converted, once they are finished, they'll be taken to the warehouse for them to be sold. So this is the transfer price, price. So basically this now how we do what? How we prepare the manufacturing account. The manufacturing what? Account. And basically after doing this now, I've said that a manufacturing entity then will still proceed and prepare the other final accounts. The statement of profit or loss and the statement of financial position. Is there any difference in terms of how we prepare these financial statements of a manufacturing entity with what you have been doing? No much difference. The only difference which exists is a slight difference when preparing this, which I've already mentioned, that when computing the cost of sales, Here, remember, you must be able to appreciate what is sold by a manufacturing entity. A manufacturing entity sells the finished goods, the finished product. So therefore, we compute the cost of sales based on the finished goods, whatever a manufacturing entity sells. So we take the opening inventory of finished goods or finished goods. And then to this, we do what? To this, we add, in this case, remember I've said we don't have purchases, but to this now we add the cost of goods which were produced, But if a manufacturing entity transfers those particular goods now to the warehouse at a transfer price, that is at least cost plus a profit. So what we consider here is the transfer price. I've said it is not all companies which will be having a policy of transferring the goods from the factory to the warehouse at a cost plus the profit. So if this one we only added, I think it was important for me to note that if any. So if a company has a policy of transferring the goods from the factory to the warehouse at a profit, that's only when you add that here. But if the company does not have that policy, in fact, that should be the end of your manufacturing account. Your manufacturing account should end at that point. That's why we are saying here, if the company do not have this policy, what you consider here is this. If the goods are transferred from the factory to the warehouse at a cost plus a profit element, what you consider here is the transfer price, this one. Yes. So then to this, we basically get something called the goods available for sale. And then now to this, we less what? We less the closing inventory of what? Of still the finished goods. Of the finished what? Goods. And basically in this case now, we will be able to get something called what? The cost of sales. I think that is the only difference which we have. And actually, after getting that cost of sales, we should less it to the sales or the revenue. We get the gross profit. We check whether we have any other income. We get total incomes and we less the normal expenses. So the expenses which we include here are the other expenses of the manufacturing entity other than what we have here. So the production cost, the costs which are incurred in the production process, they will not go to the statement of profit or loss. So actually the expenses which you include here are the administrative expenses, and maybe selling and distribution, because you can see all manufacturing expenses, all the production costs, they're included here. Yes. So that's basically how we prepare the manufacturing account. And I've said after preparing the manufacturing account, we then proceed and do what? And then prepare the statement of profit or loss and the statement of financial position in the normal way. So this is basically where we may be having a slight difference. So I'll be able to share the notes on this maybe tomorrow. Maybe someone will remind me. Is Rin in? No, can't see Rin today. Yes, maybe Benson, you can remind me to share this tomorrow. Or Peter. Yes, when getting the cost of sales, do we adjust for goods in transit? And how should we treat what? Spares, e.g. machinery spare parts, purchase and trading. Automatically those in case I've never seen a question whereby you're told there are some goods in transit. Goods in transit in relation to what? Basically, you see, whenever you sell goods to your customers, you recognize that revenue as a revenue. So therefore, whether the goods are in transit to the customers or not, you have already sold the goods to them. You recognize that as sales. You recognize that as what? As sales. How do we treat spares? Spares, machinery spare parts. I think those, in case maybe there was a spare part which was purchased, it will be told. It will be given that information, but in most of the cases that may be treated as part of repair and maintenance expense. Repair and maintenance expense, which I think should then be part of the factory overheads. So I want us to go straight to a question now. So let's look on a question. So I want us to start with, I think, the latest question on this. So we go to the past papers. So let's go to the question for, is it December? Yes, I want us, we do a question, at least we will be able to finish. I don't know whether we will be able to, okay. So can we go to this question here for April 2024? I think the question has both, actually the manufacturing statement of profit or loss, statement of financial position. I think the question do not have so many additional information. It's a question we should be able to finish. April 2024, which is the question number question number 3. Question number 3. Question number 3. Question number 3. So once you get the question, please confirm. Please confirm so that we move together. So if you're fair, yes, are you there? Are you there? Are you there? Eunice, Benson, Paul. Okay. Okay. So what are we told? What are we told here? The question is, the following trial balance was extracted from the books of 𝐎𝐍𝐿𝐍 Limited. A manufacturing company is at 31st of this March 2024. So we're given the trial balance there. And basically we have so many items there. So maybe you have ordinary share capital, revenue reserve. Revenue reserve, if you're given revenue reserve, this is another name for retained earnings or the retained profit. So then from there we have bank, we have receivables, we have payables, factory buildings, and we are told land is part of that. We have plant and machinery, motor vehicle, furniture and fittings, accumulated depreciation basically for 4 assets there. We have inventory. I've said the manufacturing companies, they have 3 items of inventory: raw materials, work in progress, and the finished product. That is something already I've mentioned. We have allowance for doubtful debts, bad debt, rent, return and insurance, direct wages, salaries, factory power, electricity, maintenance. And then we have return outwards. We have return inwards. We have advertising expenses, transport expenses, bank charges, salary expenses, purchases, and sales. Then we have additional information, number 1, all the way to note number 5. We are going to go through that as we do some workings. So what are we required to do? We are required to prepare the manufacturing account for the year which ended 31st of March 2024, 6 months. And part B, we are required to prepare the statement of profit or loss for the year which ended 31st of March 2024. And finally, we are required to prepare the statement of financial position. So I want us to go through the additional information. We see, are there some workings we need to do? So in note in addition information number 1, let's go to the addition information number 1. We are told depreciation is provided using straight line basis as follows. If it is on straight line, depreciation will be computed based on cost. So we need to compute the depreciation for those, how many assets? 4 assets. So let's compute the depreciation. And basically we will start by computing depreciation on plant and machinery. So this one we are told will be 30% automatically of the cost. 30% of the cost. So then the other asset we have motor vehicles, and the depreciation will be 25% of the cost. We will take the cost from the trial balance, and then from there we have furniture and fittings, 12.5% automatically of the cost, and then finally we have buildings, and this one will be 4% of the cost. So what I want us to do, we go back to the trial balance, we pick the cost, we take the cost of these assets. So we'll start with the cost of plant and machinery. So where do we have the cost of plant and machinery? So plant and machinery, I can see that cost below where we have the factory buildings up there. I hope you can see that. Plant and machinery, the cost is 10,920. And then for the other asset, which is motor vehicle, the cost is 71,12. The cost of furniture and fittings is 3,400. And then what is the cost of building? So the cost of buildings is basically where we have the factory buildings, just above plant and machinery. And you can see we are told the factory building is 10,500. So, and then you're told included here, because I hope you can see inside the bracket, you're told included in this cost is the value for land, is the cost for land. So 10,500, this comprises the cost of land, comprises the cost of the factory building. So what we need to do is we compute what is the cost of the building. So the cost of buildings automatically will be the difference here, which will be 6,300. So 6,300. So we need to get now these particular depreciations. So give me the first depreciation for plant and machinery. We try to hurry up so that we finish this particular question here. I try to hurry up. Yes. So what are you getting as the depreciation for? Yes, I'm told 3276. 3276. Depreciation for motor vehicles. Depreciation for motor vehicles will be how much? Depreciation for motor vehicle will be 1778. That is the figure I'm getting from Evans. So please, we try to hurry up so that we finish this particular question. Furniture and fittings. 425. And then finally, buildings 20 what? 252. Yes, 252. Okay, so we are done with that. And then you're told number 2, inventory is at 31st of March 2024 was valued as follows. So this is now the closing inventory. No working for that. We are given the closing inventory for raw material, work in progress, and the finished goods. No working for that. Number 3, we are told allowance for doubtful debts is provided at the rate of 10% of the trade receivables at the end of the year. So what we need to do there is basically we compute the allowance for doubtful debts, and basically we compare that with the amount which we have in the trial balance. So we are told this one will be 10% of the trade receivables. Trade receivables, basically, how much is that? So I hope you can see the trade receivables. Trade receivables are up there, the third item within the trial balance, the fourth item actually, which is 11,080. So this one will give us 11,080. 11 what? 1108, or basically 110.8. Should be 110.8. Eh? What are you getting? What are you getting, Chris? Okay, sawa. So then what basically we need to do is we compare that with the allowance for doubtful debts which we have in the trial balance. So remember, this is the allowance for doubtful debts at the end. So we need to compare this with the allowance for doubtful debts at the start. The allowance for doubtful debts at the start is basically the amount we have in the trial balance. The amount we have in the trial balance is 588. 588. So in this case, I can see we have what? This to this. Nicole, you're saying is what? I hope the figure this one is correct. Is it correct? 1108, is it correct? Okay. So basically, I'm saying we compare this one, which is at the start, with this one. So that is an increase. From 588 to 1108 is an increase. An increase of what? An increase of what? We try to hurry up, guys, so that we finish this particular question. We can't afford to leave the question hanging. So that is 510. So remember, this particular increase in allowance for doubtful debts, this one we account for it as an expense in the statement of profit or loss. We are done with that. Then number 4, we are told electricity rates and insurance sundry expenses maintenance are to be apportioned in the ratio of 2:1 between factory and administration. So if we are told some expenses are to be apportioned, it basically means that some of the expenses belong to the factory, and any expense which relate to the factory, it should be included within the manufacturing account. It is basically one of the factory overheads. Is one of the factory what? Overheads. So all the factory overheads, all the factory expenses, we take them into account when preparing the manufacturing account. And then in the administrative expense, because I've said when preparing the statement of profit or loss, we include what? We include the administration, the administrative expenses, and also the selling and distribution. Selling and distribution costs. So this one go to the statement of the profit and what? Loss. But I've said any factory overhead, or any factory expense, this one go to the manufacturing account. It's very, very important for you to know that. Sasa? Yes. So therefore, what we will be able to do, for example, when preparing the manufacturing account, we will be able to compute those particular expenses to be apportioned to the factory. When preparing the statement of profit or loss, we will be able to compute the expenses to go there. So I think we will do that when preparing the respective account. So number 5, we are told manufactured goods are transferred to the warehouse at the total factory cost. So if you're given that information, goods will be transferred from the factory to the warehouse at factory cost. There is no manufacturing profit. There is no manufacturing what? Profit. And I think having that now, we can be able to proceed, and basically we prepare what is required in part A. We prepare what is required in part A. That is the manufacturing statement. Manufacturing statement. What is also known as the manufacturing account. You can just refer to it as manufacturing account. Yes, and this is for the year which ended 31st of March 2024. 31st of March 2024. So for you to be able to prepare this account, what is just required is just to remember the format. If you can be able to remember the format, then to prepare this one is very, very simple. So I want you to have that title, because I want us to do this in less than 10 minutes, because now we have all the items. just the format we need to remember. Okay, so we go straight to this. Remember, in our case, we need to have basically how many columns? We need to have 2 columns here. 2 columns. And I hope you can see also our figures are in thousands of shillings. And in thousands of shillings. So here we start by taking the opening inventory of what? The opening inventory of raw materials. So it is important for you to note that when preparing the manufacturing account, we first of all compute the cost of raw materials which were consumed. Yes. So what is the opening inventory of the raw materials? That one is within the trial balance. Within the trial balance below where we have the accumulated depreciations, and the inventory, the opening inventory of raw materials is 2870. So to this, what do we need to add? We need to add purchases, and basically the purchases of raw materials. Where do we have the purchases of raw materials? The last item within the trial balance. The last item within the trial balance. We are given purchases and sales. So no need to think what is sales and what is purchases. Purchases is an expense. It should be on the debit column. So in other terms, those figures, they follow one another the way the words are arranged. Purchases come first, the sales should be on the other side. So the purchases of raw materials, therefore, is 77,000. So to this, then we have said we add the carriage inwards. And I think in this particular question, do we have carriage inwards? Do we have carriage inwards? Can you see carriage inwards somewhere? I can't see any carriage inwards. I can't see any carriage inwards. Any carriage inwards. I can't see any. Yes, and then now to this we less the return outwards, or basically the purchases return. The purchases return outwards, or basically the purchases return. Purchases return, and I think we have that. We have a return outwards. I hope you can see that figure down there over 266. Anything to be deducted, we said should always be inside there in the bracket. And then what we will be able to get here are the raw materials available for use. Raw materials available for what? For use. Give me that figure. We try to hurry up because of time. Raw materials available for use. Raw materials available for use. We try to hurry up, please, because of time. 79. 79,604. Yes. And then out to this, what do? We less the closing inventory of the raw materials. Now, the closing inventory, this one is always part of the additional information. Part of the additional information number 2. In note number 2, we have the inventory at the end of the year of raw materials, and that one is given as 11,690. It is also important to note that our figures here are in thousands. When taking any figure from the additional information, we must omit the last 3 zeros. Yes, that's why you can see we are not taking the full amount. Then here we will get the cost of the raw materials which were consumed, or basically the cost of the raw materials which were used. So this will give us what? This will give us what? 67,914. Yes. So that is the cost of the raw materials which were consumed. And then I've said to this, we should proceed and we add the other direct cost, the other direct manufacturing cost. Things like maybe the direct labor cost, the direct wages. I think in our case, I saw direct wages. Yes, there is somewhere we're given the direct wages there. The direct wages. So we add it here. The direct wages, which is basically below the rent and insurance, and that is an amount of 6440. And then now to this, we should also add any other direct cost, which is incurred in the factory, e.g. what? Royalties. E.g. royalties. And I think in our case, we don't have any other direct cost. Any other direct cost. I don't think so. I don't think we have any other direct cost. Other than what? Other than the direct wages. Okay, yes. So basically what we need to do, we need to get the total here, which now will be known as the prime cost. Prime cost. Prime cost is the total direct cost. Prime cost. And that will be what? That will be 74. $74.3. No, those are not direct expenses, Paul. They are indirect costs. They are indirect costs. Sasa, yes, that's basically what we are adding here. After that, factory power. This is not this is not a direct expense. So anytime there is a direct expense, will be given. Direct expenses include things like direct wages or even direct labor costs or royalty. Any other, like the one which I'm told there by Peter, factory power, that is basically indirect factory cost, or basically factory overheads. That's yes. So what we need to do here is we proceed and we add the factory overheads. Make sure you write that in full, or the indirect cost. The indirect what? The indirect cost. The indirect cost. You see, something like factory power. Factory power is something like maybe electricity. So electricity, basically, we know is not 100% direct cost. So if the company is not producing, company will have to pay some electricity. Some of the electricity is fixed. NASA is not a direct cost. So those costs which are pure direct are things like wages. You only engage workers to work in the factory. Whenever you are producing, you pay them based on the hours they have worked there. You only buy raw materials whenever you are producing. So all those are direct costs. But electricity you have to pay whether you're producing or not. Rent you have to pay whether you're producing or not. Your asset will have to depreciate whether you are producing or not. Those are indirect production costs. So the indirect or the factory overheads, which I want us to include here first of all, is maybe from note number 1. From note number 1, we need to ask here which asset here, which are used in the factory, because you need to know the asset. You can see the examiner, for example, he has not will not tell you which assets are used in the factory, which assets are used for administration. But basically, we know plant and machinery. Are these assets used in the factory or they are for administration? Tell me. F for factory, A for administration. Where do we use machines? Machines are used in the factory. Machines are used in what? In the factory. That's the position. Units, where do we use the machines? Machines in cocoa factories, so their depreciation will not be taught by the examiner as a factory overhead. So we have depreciation on plant and machinery. And maybe you can record those in the first column here. 3276. So what about motor vehicles? Motor vehicles, is there any information we are given about motor vehicles? So some of the assets you may be told by the examiner, like in this case, you can be told a motor vehicle is a delivery van. So if it is a delivery van, it's basically for delivering goods to customers. So that one, that depreciation should be a selling and distribution. But in this case, you can see, take into account the question is silent. In this case, we will treat that as administration expense. So we treat it as administration what? Expense, because we know a motor vehicle will not be used in the factory. We use a motor vehicle within the factory, unless maybe you're told there are those tractors for off-roading and maybe roading. Yes, but in this case, you're given a motor vehicle, the question is silent, treat that as part of what? As part of selling and distribution. So then we also have furniture and fittings. Furniture and fittings, they are not used in the factory. They are used in the office. But now this factory, this building, if you can be able to recall, we are told is a factory building. Factory building, these are factory building. So its depreciation should be part of the factory overheads. Depreciation on factory building, this one, which is 252. Yes, then we are in the additional information. I want us to go to note number 4. In note number 4, we are told there are those particular expenses which are to be shared. Basically, to apportion an expense is to share. There are those expenses which will be shared between administration, between the office and factory. One of it is electricity. The other one is the rates and insurance. And also we have the salary expenses. Salary expenses and basically maintenance. So we take these particular expenses and basically we take the amount to be apportioned to factory, the amount to be shared by factory. So let's first of all we take the expenses, but even before we take the expenses, we are told that these particular expenses will be apportioned or will be apportioned in the ratio of 2:1, between factory and administration. So the factory here will get a share of 2 out of the total, out of 3. So that is the factory share. 2 all over 3 times the expense. 2 all over 3 times the expense. 2 all over 3 times what? The expense. So let's now take the expenses. We will start with electricity, which is within the trial balance. And I think I can see that below factory power. That is 1386. And then we have rates and insurance, which is 798. And then we have salary expenses. Salary expenses, where do we have this? So we have this as the second item from the bottom of the trial balance, 2436. And then we have maintenance. Maintenance is below electricity, which is 924. So let's work out these figures. So we start with electricity. We get 2/3 of 1386. Yes, so get 2/3.
Okay.
Yes, I think I have a calculator here. 2/3, I'm told by Paul, is 924. 924, please confirm that. The other one I'm getting 532. 532. The other one 2 all over 3 times 24, 36, which is the 1624. And then the other one is 924 times 2 divided by 3, which is 616. 616. I hope that is what you're getting. Yes. So we are done with that. So we need to move to, yes, I think basically we are done with the additional information. So what we need to do is we go back to the trial balance. We pick now the other expenses which are factory related. factory related expense. Factory related expense. Maybe you can start from the last item within the trial balance. We have purchases. Is not an expense. We have dealt with sundry expenses. Bank charges. Bank charges is not a factory related expense. This is administrative expense. Transport. Transport, this basically transport expenses is also administrative, or maybe selling and distribution. It cannot be a factory, because factory we can only have carriage inwards of raw materials, which you already considered up there. Advertising is a selling and distribution. You advertise in order to sell. This is not a factory expense. Return inwards, that one will be deducted from the sales. Return outwards, we have dealt with that. Maintenance, we have dealt with that here. Electricity, we have dealt with that. And then we have the factory power. Factory power is basically a factory overhead. A factory power, which is 1890. And then above that, we have salaries. Salaries, were these to be apportioned? No. So, but in this case, salaries, if the question is identity is administration, because in factory, what is paid are wages. Wages are like salaries, but wages are paid based on the time you work. Sasa, yes. So then above that, we have direct wages. We have dealt with that. Rent and rent and insurance. We have dealt with that. Budget, this is a selling and distribution. So, and then we have allowance, which is still a selling and distribution. Then we have inventory accumulated. After, I think we have the asset only. So we don't have any other expense here or any other factory overhead. So what we need to do is we basically get the total and we take that now to the last column. So let's get the total here. 3276 plus 252 plus 924 plus 532 plus 1624 plus 616 plus 1890. So I'm getting a figure of 9114. Confirm whether that is the figure you're getting. Yes. So we added to this. We added to that. That is 74,354. And I'm getting 83, 468. So confirm whether that is the figure you're getting. Confirm whether that is the figure you're getting. Is that the figure you're getting? Okay, sawa. So then to this, we have said we proceed, and basically we do what? We add opening work in progress. We add opening work in progress. Opening work in progress. So we add this, and basically we less the closing work in progress. Yes. So, and in our case, we have this work in progress. The opening work in progress is within the trial balance. So can we go back to the trial balance? The opening work in progress is given as 4830, and then the closing work in progress is given within note number 2. Within note number 2 is given as 6930. So, and then now to this, we will get the cost of the goods produced. The cost of goods produced. Cost of goods produced. So give me the final figure here. So we take this one, we add 4830 minus 6930. Yes, so basically that's the figure I'm getting. I don't know whether that is the same figure you're getting. Yes. Basically, that is it. That what is required as far as the preparation of the manufacturing account is concerned. And the marks are located there were 6. Automatically, these are the items which are marked here. These are the items which are marked. And basically, by doing that, you get 6 marks. So let's move to part B. And basically, we are required to prepare the statement of profit or what? Or loss. Basically, for the year which ended 31st of March 2024. 31st of March 2024. Basically, I've said there is no much difference in terms of how we prepare this. So to prepare the statement of profit or loss, it all depends on whether this business is a company, whether it is a partnership, whether it is a sole proprietorship, because it is also important for you to note that a manufacturing business may be conducted as a company, may be conducted as partnership, may be conducted as what? Sole proprietorship. But I think this is a company. So this being a company, I don't think we have much challenge in terms of how we prepare this. So we will start with the sales. But remember here, we need to have 2 columns. We need to have 2 columns. I hope you can be able to see that far ahead. Yes. So we start with the sales. And basically sales is given as the last item within the trial balance. Sales as an amount of 103,600. Sales should be on the credit side of the trial balance because it's an income. So to this we less the return inwards. The return inwards. So the return inwards, I can see that within the trial balance, there's a figure of 84. So we less it there, and basically we get the net sales. We get the figure for net sales. Net sales will be how much?